Hi, we're going to start session 6 quiz review of frequently missed questions by looking at number 1. The rules state that in order to find out how much of your Social Security is taxable, you first have to add up all of your taxable and non-taxable income plus half the amount of your Social Security and get your results. We have $19,000 of pension income plus $1,000 of municipal bond interest plus $6,000, which is half of the $12,000 of Social Security benefit that this taxpayer received. Once we add all those up, we end up with $26,000. So you take that $26,000 and subtract out the exemption amount for that filing status for Social Security. Since you're married filing separate, the exemption amount is $25,000, and we end up with a positive result of $1,000. Now, if you had a negative amount, then that would tell you that none of your Social Security would be subject to taxation. But in this case, we have a positive amount, so now we have to take another step and take that $1,000, compare it to the amount for your filing status for taxable Social Security, which in this case is $9,000 for married filing separate. So $1,000 is less than the $9,000, so we do not have to use the Social Security benefits worksheet. We can just divide the $1,000 amount by 2 and figure out how much the taxable Social Security is for this return. Now, let's take a look at question 6, which is a little bit different situation. Maggie is 73 years of age. She received Social Security benefits of $8,000, which includes $500 for Medicare premiums. Withdrawals from her IRA were $16,000, and she received $22,000 from a pension. She also had other income of $14,000. How much is Maggie's adjusted gross income? The question that's being asked is how much is her adjusted gross income? But first, we need to figure out if any of her Social Security benefits are taxable. So we'll go back to the same formula as in question 1. We'll add up all of her income, including any non-taxable income that she has, plus half of her Social Security benefit to get our results. So $16,000 in IRA withdrawals, $22,000 in pension, $14,000 in other income, plus half of her Social Security, which in this case is $4,000. Add all those together, we get $56,000. We subtract the exemption amount for her filing status, which is single. That's $25,000. We end up with $31,000. We have to take that amount and compare it to see how we are going to figure out how much is taxable. So $31,000 in this case is greater than $9,000, so we must use the Social Security benefits worksheet to figure the taxable amount. I've gone ahead and done that for you. Let me bring it up here. So we see here on Maggie's Social Security benefits worksheet, line 1 is asking for the amount of Social Security. Line 2 is dividing that amount in half. Line 3 is adding up all of her taxable and non-taxable income. We don't have any amounts for line 4, nor do we have any exclusions or adjustments that we have to add back in for line 5. So we add lines 2 and 3, 4 and 5 together, and we end up with $56,000. We're going to take that $56,000 and we're going to subtract out the $25,000, which is the amount for single. We end up with $31,000. We're going to compare that $31,000 to the $9,000. It is more, so we subtract the $9,000 out. We end up with $22,000. Now, the rest of the worksheet is doing some comparing back and forth between the smaller of what your limit is and how much income that you have. So on 12, we're subtracting line 11 from line 10. We get $22,000. Then on line 13, we're going to enter the smaller of line 10 or line 11. The smaller is $9,000, so we enter that on line 13. We're entering 1/2 of line 13. Then we take a look again at line 2, which is $4,000, or line 14 and enter the smaller of the two. In this case, it is line 2, half the Social Security benefits of $4,000. Then we're going to multiply line 12 by 85%, Line 12 is the $22,000. Multiply that by 85%, we get $18,700. You add lines 15 and 16 together, and on line 17 we get $22,700. You multiply line 1 up here, which is the entire amount of the Social Security benefits, by 85%, and you end up with $6,800. Now, the final line, line 19, figures out what the actual taxable benefits are. So you enter the smaller of line 17 or line 18. In this case, line 18 is the smaller, which is 85% of the Social Security benefits. So on line 19, we enter $6,800, and we will also enter that on Form 1040, line 20B for taxable Social Security. So since the question asks, what is her adjusted gross income, we will actually need to go through and take a look at the 1040. So we have Maggie Mae's 1040 here. Going ahead and enter $16,000 on line 15B. Her IRA distributions. We'll enter $22,000 on her pension. We're going to enter that taxable amount of the Social Security that we figured out on the Social Security benefits worksheet. Her entire amount goes on line 20A. The taxable amount goes on line 20B. Her other income, line 22, asks us to add all the amounts from 7 through 21 together. We have $58,800. We did not give you any adjustments in the adjustment section of the 1040, so we just bring the $58,800 down to line 37, and this is Maggie Mae's adjusted gross income. Now let's go over the mini problem. Jonathan was born in 1944, and Martha was born in 1946, are married. Jonathan retired from his job with the U.S. Postal Service on June 1, 2010, after 30 years of service. The tax-free portion of the annuity recovered in 2010 and 11 was $1,838. During the year, the Kents had the following combined sources of income: savings bank interest, $2,500, tax-exempt interest, $1,000, an annuity for Mr. Kent of $25,000, gambling winnings of $600, and Social Security of $15,000. Jonathan's annuity is payable for his life and that of his beneficiary, Martha. The Kents will file a joint return. Using the Simplified Method worksheet and the Social Security Benefits worksheet, determine the taxable portion of Mr. Kent's annuity and the taxable portion of their Social Security benefits. Then answer questions 8 through 12. So let's go ahead and take a look at both of those first. Number 1, asks you to enter the total pension or annuity payments from Form 1099-R, Box 1. We have told you that that is $25,000. Line 2 asks you to enter the cost in the starting date of the plan. We've told you over here in the problem that the contributory amount was $30,000. So that is the amount that you put on line 2. Enter the appropriate number from Table 1 below. But if your annuity starting date was after 1997 and the payments are for life and that of your beneficiary, enter the appropriate number from Table 2 down below. So this is what seems to get everyone confused. They don't know which table to use, and so they end up using 260 rather than using 310 here. So that 310 is the amount that you want to enter on line 3. You divide line 2 by 310, and we end up 96.77. Then it says multiply line 4 by the number of months for which this year's payments were made. This year's payments were made for 12 months. You can see over here, 9677 times 12 equals 1,161. That's what we will enter on line 5. Enter the amount of any that was covered tax-free. And we did tell you up here in the description of the problem that the tax-free portion that was recovered in 2010 and 2011 was $1,838. So you subtract line 6 from line 2, we end up with $28,162. And then on line 8, we're to enter the smaller of line 5 or line 7. Line 5 is the smaller, it's $1,161. That's what we enter on line 8. So let's take a look at what they were asking us to do here from lines 3 to 7. How much of each monthly payment is going to be able to be recovered tax-free for the year? So that is the amount of each payment that's going to be able to be recovered tax-free for this year. So when we multiply the 96.77 by 12 months, we end up with $1,161. Now we need to look at how much you've already recovered tax-free. We know that from your prior year's simplified method form that you've recovered tax-free already is $1,838. So then we subtract that amount from line 2. The amount that you have left to recover tax-free is $28,162. We're going to subtract out this year's amount that's going to be recovered tax-free, and so we end up with $23,839 that's going to be taxable this year. Now, when on line 40, you add line 6 and line 8, and on line 10, you're going to get $2,999. That is the number that will be brought forward to line 6 for next year to track the amount that you've already recovered tax-free. So now let's move down. Let's take a look at what their taxable Social Security benefits are. So the amount of their Social Security benefits, $15,000. Divide that by 2, we end up with $7,500. We're going to combine the amounts of taxable and non-taxable income that they have for this year. So $26,939. We're going to have $1,000 in non-taxable. So we add those three together, come up with $35,439. It's asking us if the amount on line 7 is less than the amount on line 6. Yes, it is. So bring down line 6. $35,439. Now, in this case, this couple is married, so their exclusion amount is going to be $32,000. So we're going to subtract $32,000 from the $35,439, and we end up with $34,439. Since they are married, we are going to compare that to the amount of $12,000. Subtract line 11 from line 10, and if it's 0 or less, enter 0. It is 0 or less, so we're entering 0. Then we're going to look at entering the smaller of line 10 or line 11. In this case, line 10 is less than line 11, so that's what we're entering, $3,439. Enter 1/2 of line 13, which is $1,720. Enter the smaller of line 2, which is $7,500, or line 15. Line 14. Line 14 is the smaller, so we're entering $1,720. Line 16 says to multiply line 12 by 85%. Since line 12 is 0, there is no number there. Then we're supposed to add lines 15 and 16 together, and there's nothing on 16, so we just bring the number down from 15, 1,720. Then we're multiplying line 1 by 85%. Line 1 was the original amount of Social Security of $15,000. And when you do that, you end up with $12,750. Now we're going to look at the smaller of line 17 or 18, and line 17 is smaller. So this is the amount of taxable benefits for this year for the Kents, $1,720.
Topic of the day, which is adjustments to income, and it is a full course with lots of stuff in it. And we're going to be covering all of these items in turn in the order in which they appear on the 1040 form, beginning with educator expenses, business expenses of reservists, performing artists, and fee basis government officials, health savings accounts, moving expenses, the deductible part of self-employment tax, self-employed health insurance deduction, the penalty on early withdrawal of savings, alimony, IRA deduction, the student loan interest deduction, the tuition and fees deduction, and you might think that that would be it and we're done, but there are even some more adjustment items not listed here that we will also get into today. Now you'll see that this manual does have a list of reading. This is where you would go. These are source documents I utilized in preparing the material for today's class. And my job as an instructor is to really look for the core ideas that I feel are important, things that I've personally run across in my own experience as a tax practitioner, things that I needed to know for the active preparation of tax returns. And when I run across something in the real world that confuses me, I realize, well, if I'm confused, probably lots of people are confused about this, and then that's something I'll research and incorporate into our courses. But it's impossible for me to cover everything or to know everything. I just put into this course what I feel is the most relevant and topical. Moving on with our introduction to the course, we'll just explain what an adjustment to income is. Commonly referred to as above-the-line deductions, adjustments to income allow you to deduct certain expenses from your gross income without the requirement of reporting them on Schedule A. Adjustments are claimed on lines 23 through 37 of Form 1040. And you can see right here I've got a cutout of the bottom part of the first page of 1040, and we've got lines 23 through 37, and that's where we claim our adjustments. There are a few adjustments that can be claimed on Form 1040A, but since 1040A only allows some adjustments and not all of them, I really won't explore 1040A at all. We're going to do it all on the long form. Now in recent years, and I'm talking within the last 20 years, the number of adjustments available as adjustments to income has increased because Congress and Presidents Clinton and Bush pushed to make certain deductions available to greater numbers of filers. When I first got into this business 20 years ago, for example, the moving expense deduction was not an adjustment to income item. It actually belonged on Schedule A and was claimed on Schedule A. And so there was no line under the adjustments information for moving expenses. And there's lots of other lines in here that have appeared over time as well. For example, the student loan interest deduction, the tuition and fees deduction, the domestic production activities deduction. Certain business expenses of reservists and performing artists, those are not necessarily new to the realm of adjustments, but they created a new line for those several years ago. And so just to kind of let you see how many of these adjustments have just been added over time, and for the larger part of tax preparation history, there were a lot of adjustments that just simply didn't exist and have been added more recently. Now, in a nutshell, adjustments to income are deductions that you can use to reduce what is referred to as your adjusted gross income. Adjustments are different from itemized deductions because they are a direct subtraction from your income on the front page of the Form 1040. Itemized deductions can be claimed instead of your standard deduction, but adjustments to income can be claimed in addition to your standard deduction. So you could say adjustments are better in that you're not forced to itemize to claim them. And let's move on to the first adjustment that we're going to talk about today, which is the Educator Expense deduction. This has always been a temporary deduction that keeps getting extended, and it had expired for 2012, but the Taxpayer Relief Act of 2012 that was passed on New Year's Day of 2013 extended this provision. And so it was in play for the 2012 season and will be available through 2013 as well. The deduction is a maximum of $250 per educator. If you have a married couple and both of them are teachers, therefore the deduction could increase to a maximum of $500. But I typically think of it as a $250 limit. To claim the deduction, you must be an eligible educator, and an eligible educator is a person who meets the following requirements. They work with kindergarten through grade 12 as a teacher, instructor, counselor, principal, or aide, and they work at least 900 hours during a school year in a school that provides elementary or secondary education as determined under state law. The deduction is not available to home school teachers. Should also point out it's not available to preschool teachers because, after all, preschool would not be K through 12. Qualified expenses include unreimbursed expenses that you paid for books, supplies, other than non-athletic supplies for courses of instruction in health or physical education, computer equipment, other equipment and supplementary materials used by the educator in the classroom. And that's pretty much all there is to say about the educator deduction. It's around if you're working with a school teacher. A common question I ask, of course, is did you purchase any supplies for the classroom this year? Not all teachers do. I have many teachers who say they make a point of spending nothing. I have other school teachers that spend thousands in a year, and the educator expense deduction is just merely a drop in the bucket. And then I have others who say, well, I didn't keep receipts. I had a few, but I don't bother with it. But for those who are on top of it and want to claim that deduction, it is a handy one, and that's why it's there for them. The next deduction we're going to spend a little bit more time on, and that is the deduction called Certain Expenses of Reservists, Performing Artists, and Fee-Basis Government Officials. It's claimed on line 24 of the 1040. And we're going to start first with these performing artists. I laugh at the performing artist category because it's never been adjusted for inflation in the 20 years I've been doing taxes, which means that as time passes, the parameters under which you might be able to claim this particular adjustment just shrink. I have not, I'm thinking maybe once in 20 years I've ever had a performing artist that qualified for this deduction because it's got pretty restrictive rules, and let's see what they are. Certain performing artists can claim their qualified employee business and educational expenses as an adjustment to income rather than as an itemized deduction. So most of the time when you have employee business expenses, you claim them on Schedule A subject to a 2% limit, and in certain cases Form 2106 is required, so you also attach that to your return. But if the expenses have been incurred by a performing artist who meets these criteria, then the expenses can be claimed directly on the front page of the tax return, and 2106 is attached to describe the expenses, but the deduction is claimed as an adjustment rather than an itemized deduction. But here are the rules. As a performing artist, all of the following have to apply to you. During the year, you performed services for 2 or more employers, and you were paid at least $200 by 2 or more employers. Each of them paid you at least $200. Your related performing arts expenses are more than 10% of your income for performance of those services, and your AGI cannot be more than $16,000 before deducting these business expenses. So you could say that this deduction is exclusively reserved for what we might refer to as a starving performing artist who's not making very much money but is working for at least 2 employers who are paying them on a W-2. Each employer paid at least $200. And their expenses are more than 10% of their income from those employers. If that's the case, then you enter the expenses for that performing artist on Form 1040, line 24, and then attach Form 2106 or 2106EZ to the return. Fee-basis government officials. Fee-basis government officials are persons who are employed by a state or local government and who are paid in whole or in part on a fee basis. They can deduct business expenses in performing services in that job as an adjustment to gross income rather than as a miscellaneous itemized deduction. How do you claim the deduction? Claim the deduction again in the same way I just described for performing artists. Deduction of overnight travel expenses of National Guard and Reserve members. This is actually, of the deductions we're talking about, this is the deduction that is the most recently added. And at the time the IRS made provision, or the federal government made provision for this specific type of deduction, that is when a line was added to 1040 to basically make it stand out and ensure that overnight reservists or National Guard members, reservists or National Guard members traveling away from home overnight might actually notice that that deduction was available to them. But as tax practitioners, it's our job to obviously understand when a deduction is available to a reservist or National Guard member and how to go about claiming expenses that can be claimed in this way. Now the rules are this. Firstly, you have to be a reservist or a National Guard member who stayed overnight away from home and also traveled more than 100 miles away from home while on service. For example, you go away from home overnight for a drill meeting or for your 2-week camp, and while you're away from home, you incur unreimbursed travel expenses. And it's the travel expenses only that are deductible by the reservist. Travel expenses include transportation, meals, and lodging. The deduction is limited to the rates for such expenses authorized for federal employees, including per diem in lieu of assistance. And so what they're essentially saying is there's a federal per diem rate that you are allowed to claim, and they don't want to see you claiming more than that. How do you claim the deduction? Well, you claim the deduction on Form 1040, and you attach Form 2106, and then enter the amount on line 24 of the 1040. Health savings account is the next topic. That's carried to line 25 of the 1040. Individuals who are covered only by a high deductible health insurance plan may be able to make tax-deductible contributions or salary reduction contributions to an HSA. There are 3 important tax benefits that are associated with HSAs, and they include: amounts contributed to the HSA are deductible from your income. Amounts contributed to the HSA are allowed to grow tax-free inside of the HSA, and distributions from the HSA are tax-free provided they are used to pay qualified medical expenses of the account beneficiary or the beneficiary's spouse or dependents. So if you have a high deductible plan, and we'll discuss what that is, you can open up an HSA, and it works much like an IRA. In fact, it's considered to be a type of individual retirement account. You open up the HSA and you put money into it, and you get a deduction for the money you put into it. And the money is allowed to sit in there and grow over time, increase in value, much the way money inside any other kind of retirement plan might grow over time. And when you have a medical expense, you can take the money from the HSA and use it to pay the medical expense. So let's look at what the specifics of HSAs are next. An HSA is a tax-exempt trust or custodial account established exclusively for the purpose of paying qualified medical expenses of the account beneficiary, who, for the months for which contributions are made to the HSA, is covered only under a high deductible plan, who is eligible to participate or establish an HSA. HSAs are set up with a bank, an insurance company, or anyone already approved by the IRS to be a trustee of an IRA or an Archer MSA. No permission or authorization from the IRS is required to set up an HSA. You must be an eligible individual to establish an HSA, and an eligible individual is any individual who in any month meets the following criteria. That individual is covered under a high deductible health insurance plan on the first day of that month, and is not also covered by any other plan that is not an HDHP, but there are certain exceptions for plans providing certain limited types of coverage. And the best example I can give of a plan with limited types of coverage might be AFLAC. We think of AFLAC as being a type of health insurance, but they offer very limited coverage for very specific situations. So if you have AFLAC in addition to your HDHP, it won't prevent you from opening a health savings account. You must not be enrolled in Medicare, and that generally means you have not yet reached the age of 65, and you are not claimed as a dependent on another person's tax return. So it actually sounds like it's a pretty simple thing. You go down to your bank and you tell them you want an HSA. You're supposed to meet the criteria first, of course, and assuming you do, you open up the account and you put some money into it. When you put the money into it, you can claim a deduction for it. Now, I don't see very many people opening up HSAs that way. Most of the time it happens through their employer, and sometimes they're even doing salary reduction from their employer or through their employer into that plan, or their employer is making contributions for them. But it could be the case that you just decide to go open one up, and if you're self-employed, that may be exactly what you decide to do. So what is a high deductible health plan? When do you meet those criteria? Well, generally an HDHP is a health plan that satisfies certain requirements with respect to deductibles and out-of-pocket expenses. For 2012, these amounts are as follows. For individuals, an HDHP has an annual out-of-pocket deductible of at least $1,200, and maximum expenses to be paid by the individual are not to exceed $6,050. For families, an HDHP has an annual deductible of at least $2,400, and annual out-of-pocket expenses required to be paid by the family do not exceed $12,100. For family coverage, though, an HDHP is only an HDHP if it does not provide any member of the family any benefit at all until the $2,400 deductible has been met. Copays and preventative care coverage. A plan does not fail to qualify as an HDHP merely because it does not have a deductible or has a small deductible for preventative care. For example, first dollar coverage for preventative care. However, except for preventative care, a plan may not provide benefits for any year until the deductible for that year has been met. So for example, Kaiser, if you have your health insurance through Kaiser, Kaiser charges a premium, you pay a premium, and you might have signed up for a high deductible plan under Kaiser. But Kaiser would still provide you with access at no charge, no deductible, no copay to all of the preventative care offered through that particular institution. So even though you're allowed all that preventative care at no charge, it doesn't prevent you from having an HDHP, because if something actually really got wrong with you where you had to pay for hospitalization or have a particular procedure that was required, Kaiser would demand that you pay out of pocket before it kicks anything in. Of course, dependent on the type of plan you have with Kaiser and assuming it is an HDHP. So here's another example. A plan is not a qualifying HDHP in this situation. Plan A provides coverage for Jack and his family. The plan provides for the payment of covered medical expenses for any member of Jack's family if the member has incurred covered medical expenses during the year in excess of $1,500, even if the family has not incurred covered medical expenses in excess of $2,400. Thus, if Jack incurred covered medical expenses of $2,000, because the deductible is $1,500, then the plan would pay him $500. Since benefits are potentially available under this plan, even if the family's covered medical expenses do not exceed $2,400, this plan is not considered to be an HDHP. Let's look at the similar example, but we do have an HDHP. We have the same facts as in the previous example, except Plan A now has a $5,000 family deductible and provides payment for covered medical services if any member of Jack's family has incurred covered medical expenses during the year in excess of $2,400. The plan satisfies the requirements of an HDHP with respect to these deductibles. So how much can be contributed to an HSA during the year? There are limits on it. The amount you can contribute to your HSA depends on your age and whether you have a self-only or family health insurance coverage. If either spouse has family coverage, both spouses are treated as having family coverage with the lower annual deductible of the two health plans. So what are the types of coverage? Well, for self-only, the amount of money that you can contribute during the year if you are under age 55 is $3,100. But if you are age 55 or older, there is a catch-up amount, an additional contribution you can make of $1,000, and you could put as much as $4,100 into your HDHP in a year if you are age 55 or older. Now, if you have family coverage, the maximum amount you can contribute to the HDHP is $6,250, but if you are age 55 or older, you can actually put $7,250 in, which is an additional $1,000 catch-up amount. And if both you and your spouse are age 55 or older, the catch-up contribution amount moves up to $8,250. The amount that you can contribute to your HSA is reduced by any amounts that you contributed to an Archer MSA during the year, or employer contributions that your employer made to your HSA on your behalf and were excluded from your income, and transfers from your IRA to your HSA, which is interesting because you can make a rollover from your IRA into an HSA. That might be a way to provide funding to it if you needed that. Reporting contributions and distributions from HSAs. You use Form 8889, shown right here, to report any contributions that you are making to your HSA and also to figure the limit and allowable deduction for amounts that you contribute. You also use it to report distributions from your HSA, and you use it to figure the amount of taxable income and or penalty that you may owe because you took a non-qualifying distribution from your HSA. So we have Form 8889, and it's basically got two parts. You can see Part 1 right here and Part 2 down here in yellow. You use Part 1 of the form to figure your HSA deduction, report any excess contributions you made or those that were made on your behalf, and to report any excess contributions that were made by your employer. On line 9 down here, if your employer made contributions for you, this is where you enter them. And line 13 down here is the HSA deduction. If you are eligible for deduction, it will show on line 13, and we'll do an illustration so you can see how it works. In Part 2, we use Part 2. On line 14A, you enter your total distributions that you received during the year from all of the HSAs that you have. These amounts should be shown in Box 1 of Form 1099-SA. And I have customers bring in Form 1099-SA quite regularly, And anytime you have a 1099 SA with a number on it for a distribution, Form 8889 is required. On line 15, if your client did take a distribution, you're going to need to report the amount of qualified expenses they paid during the year. Any amount on line 15 would reduce the taxable income that is generated by entering an amount on line 14A. And if line 15 is greater than or equal to line 14A, then none of the distribution is taxable, because if you spent all of the distribution on qualifying medical, then that is an appropriate use and accepted permitted use of the money, and it's a non-taxable distribution. And then if any of the distribution is taxable, that taxable portion of the distribution is entered on line 16, and a penalty would then be owed in most situations on the taxable portion of the distribution. The penalty is generally 20%, an additional 20% tax. And so let's just say you had $1,000 of taxable distribution. You don't meet an exception to the penalty. The penalty would therefore be $200, and you'd enter that on line 17B, and then you'd carry the penalty to line 60 of your Form 1040 and enter it as a tax amount. So again, who must file Form 8889? You have to file the form if any of the following applies. You or someone on your behalf made contributions for 2012 into your HSA. You received HSA distributions in 2012. You acquired an interest in an HSA because of the death of the account beneficiary. Or you must include certain amounts in income because you failed to be an eligible individual during the testing period. There's a special note here for people who are shareholders in an S corporation. Owners and officers who have greater than 2% share of a subchapter S corporation cannot make pre-tax contributions to their HSA through the company by salary reduction. In addition, any contributions made to their HSAs by the corporation are taxable as income, and in fact the corporation would have to show any contributions made to the shareholder's HSA as wage income on a W-2 issued to that shareholder. However, S corporation shareholders can make their own personal contributions to their HSAs and then take the above-the-line deduction on their personal income tax return. For partnerships, we have similar rules. Partners in a partnership or LLC cannot make pre-tax contributions to their HSA through the partnership by a guaranteed payment reduction. However, partners can make their own personal contributions to their own HSAs and then take an above-the-line deduction for their personal income tax returns. Distributions from HSAs. An Archer MSA or an HSA is not taxable when you take a distribution from it if you used it to pay qualified medical expenses of the account holder and family, or you rolled it over. An HSA can be rolled over into another HSA. An Archer MSA may be rolled over into another Archer MSA or a health savings account. But an MAS-MSA, which is kind of an older program not really utilized anymore, is not taxable if you used it to pay qualified medical expenses of the account holder only. So when this concept of health savings account was first introduced, near the beginning of the Bush term, I think, somewhere in there is when they first came out, we had the Archer MSA, and there was also this MA-MSA. I saw virtually none of the Archer MSAs or the MA-MSAs when they came out. It was several years that we had these health savings type accounts out before I even started to see clients that utilize them. But when the HSA came out, I started to see greater numbers of clients who had these types of accounts. And now they're something I see fairly regularly. Distributions not used to pay qualified medical expenses are taxable. If you did not use the distribution from an HSA, Archer MSA, or MA-MSA to pay for qualified expenses, or in the case of an HSA or Archer MSA, you did not roll it over, you must include that distribution in your income. And in most cases, the distributions are subject to a 20% penalty unless an exception applies. If an exception applies, you would check the box on line 17A of the Form 8889, and then on line 17B, you would only enter a 20% penalty based on the amount that does not qualify for the exception. So what are possible exceptions that would prevent you from having to pay the 20% tax? Well, there's three main ones. It does not apply, that is, the 20% additional tax does not apply if the account beneficiary dies or becomes disabled or turns age 65. In any of those situations, the money can come out, not be used for medical, and a penalty will not apply. But if you don't meet one of those exceptions, you take money out and you don't use it for medical, and it becomes taxable as a result, then the penalty does apply. So here's an example of when an exception does not apply. You turned age 63 in 2012 and received a distribution from an HSA that is included in your income. Do not check the box on line 17A because you, the account beneficiary, did not meet the exception for the distribution. Enter the 20% penalty and pay it. Example number 2, an exception does apply. You turned age 65 during 2012. You received distributions that are included in your income both before and after you turned age 65. Check the box on line 17A because the additional 20% tax does not apply to the distributions that were made after the date you turned age 65, but the 20% tax does apply to distributions you took before you turned age 65, assuming those distributions were not spent on qualifying medical expenses. And here I have a 1099 SA to show you. This is a document that pretty much when my clients have it, it looks like this. When we're looking at investment type documents, 1099 INTs, 1099 DIVs, 1099B brokerage statements, most of the time our clients are coming in with substitute statements that don't look anything like the IRS standardized statement. But in the case of HSA distributions, when my clients take an HSA distribution, they will generally come in with a document that looks exactly like this one. So it should be a good reference for you. And any amount that they took from their HSA is going to be reported in Box 1. A number in Box 1 tells you that you need to prepare and file Form 8889. It doesn't mean that they owe taxable income. It doesn't mean that they owe a penalty, but it does mean the 8889 is required. And in preparing the 8889, you're telling the IRS that a distribution did occur. And then on the 8889, if qualified medical expenses were paid, you're going to indicate how much they were. And then if the medical expenses are less than the distribution, you would figure the taxable amount and the penalty if it applies. But if the medical expenses are equal to or greater than the amount shown in Box 1, then none of the distribution would be taxed. So ultimately, Form 1099 SA mandatorily creates a need to file Form 8889. Box 1 is where the gross distribution is reported. Box 2 will report earnings on excess contributions. If you put too much into the account, you're not allowed to do that, and the HSA trustee is supposed to report any earnings on your excess contributions. You do need to pull those out or you'll be subject to a penalty on those. And then Box 3 is where a distribution code is entered. And most of the time you're just going to see a normal distribution. But if it was a distribution because of an excess contribution, you would see a code 2. If it's a distribution due to disability, you would see a code 3. If it's a death distribution, a code 4. And of course, disability and death distributions would be 2 exceptions to the 20% additional tax. Deemed distributions from HSAs. You must be careful to follow all of the rules that apply to HSAs, or you may be required to report income and pay a penalty if you make a non-qualifying contribution or take a disqualifying distribution from the HSA. The following situations result in deemed taxable distributions from your HSA. Number 1, you engaged in any transaction that is prohibited by Section 4975 with respect to any of your HSAs at any time during the year. If that happens, your account ceases to be an HSA as of the first day of the year, and you must include the fair market value of all of the assets in the account on the first day of the year on 8889 line 14. Or you used any portion of any of your HSAs as security for a loan at any time during 2012, and if that happens, you include the fair market value of the assets used as security for the loan and to enter them as income on line 21 of Form 1040 and again pay the penalty. Now, any deemed distributions in either of these prohibited actions will not be treated as if they were used to pay qualified medical expenses, and they would be subject to the 20% tax. If any of you are scratching your heads and wondering when it went to 20, it went to 20 for tax years 2010 and later, and prior to that it was a 10% penalty. So how do we go about claiming a deduction for HSA contributions? Well, you claim the deduction on Form 1040, line 25, and attach Form 8889. And to show you how all of that works, I created an illustration here where we have a character who made a contribution to his HSA during the year, but also took a distribution from his HSA during the year, and that's quite normal. People who have HSAs, they're putting money in and they're taking money out all the time. That's basically the point of the HSA. We have Steve Trevor. born in 1955, who made direct contributions to his HSA account totaling $3,100 for the year. His employer also contributed $1,000 to his HSA on his behalf. Steve's qualified medical expenses for the year totaled $4,000, and he took a distribution from his HSA in the amount of $3,100. Steve's W-2 and his Form 1099-SA are shown below. Prepare Form 8889 in page 1 of his tax return so you can see how it works. Well, on the HSA, you can see that we show that gross distribution in the amount of $3,000, and that amount is going to be carried to line 14A of the Form 8889. So you see an HSA 1099, that tells you 8889 is required, and you're going to carry the amount in box 1 to the form and enter it on line 14A. You have a client who has a W-2, and you look at the W-2 and it has a box 12 with the code W in it. That tells you Form 8889 is required, because that means that that employer either made a direct contribution to the HSA on behalf of the employee, or the employee did a salary reduction into the HSA. Either of those creates a need for the form, in addition to the fact that Steve made direct contributions. So even if he hadn't made direct contributions, he'd still be required. But here he has a W on his form, and he also made direct contributions. So for sure we need to fill out the form. And here is Steve's form. We begin, because he's single and has self-only coverage, we check the self-only coverage box. Then on line 2, this is the amount that Steve contributed directly to his plan. And on line 3, Steve's contributions are limited to $3,100 plus $1,000 because he's age 55 or older. So he gets that extra $1,000 catch-up contribution amount. We carry that amount down until we get to line 9, and on line 9, his W-2 showed $1,000. $1,000 has already been contributed to his HSA tax-free, so we're going to need to enter $1,000 on line 9, and that reduces the amount that he's allowed to take a deduction for. His deduction is going to be $3,100, and he enters that amount on Form 1040, line 25. We then go over to Part 2, and because he took a distribution, we've entered that $3,000 distribution amount on line 14. And on line 15, we have to indicate how much money he spent during the year on qualified medical. His expenses for medical exceeded his distributions from the plan, so he has zero taxable amount. Nothing is reported in his income, and he owes no penalty. So in the perfect world where an HSA is being used the way it should, this is how things should ultimately look out. You're simply using Form 8889 to report the activity that went on with the account, but it's not really creating a taxable income situation. And in Steve's case, it is triggering a deduction. Here's the front of Steve's 1040 form, and we can see that on line 25, we've entered that $3,100 deduction for his health savings account contribution. And the next topic of the day is moving expenses. We enter those on line 26 of the Form 1040. And remember at the beginning of class I mentioned that there was a period of time, most of the history of tax law, that when moving expenses were deductible, they were claimed on Schedule A. But shortly after President Clinton came into office, I'm trying to think, it was in the mid-90s, moving expenses moved off of the Schedule A and onto the front page of the 1040. There was good things and bad things that went on with that. The good thing was that you no longer needed to itemize to claim your moving expenses. And that was important because lots of people have moving expenses but don't have enough to itemize. And so those people were for the first time able to claim moving expenses as a deduction and weren't excluded from being able to do that because they didn't have enough to itemize. But the flip side of the equation was that moving expenses used to be a much broader category. There was a lot more stuff you could deduct when the moving expenses were claimed on Schedule A. For example, you could claim house hunting expenses on Schedule A and temporary living expenses on Schedule A when you were able to claim moving expenses under those old rules. And why am I talking about something that disappeared so long ago? Well, I'm talking about something that disappeared so long ago because there's clients who still remember those good old days when they could deduct all of that stuff. And many employers, larger employers who are paying for high-value employees to travel them around the country and so forth, still make a practice of paying those types of expenses in the process of hiring or moving their workers. And so people do bring this stuff up. Hey, you know, my employer paid for temporary housing for me, or my employer, you know, I lost money on the sale of my house, so my employer kicked in and gave me the money I lost. They'll say things like that. And it's just important to understand that there was a period in time where those things wouldn't have been taxable, but that was a long time ago. Today, those types of activities are considered taxable if they're paid by the employer, and if you paid them yourself, they're simply not deductible. So today, the moving expense rules, you might say, are simpler because there's less that you can deduct. You can say no to most things. But the key important things that you would typically associate with a move are still allowed. Of course, you have to meet the requirements to claim moving expenses, so let's talk about what those are. Moving expenses may be deductible if they are associated with moving to a new home where you work and meet certain other tests as follows. Generally, you must begin to work at a new job location within 1 year of the date of the move. And generally, you must also meet the time test. Employees must work full-time at least 39 weeks during the first 12 months. And self-employed people must work full-time at least 39 weeks during the first 12 months and 78 weeks during the first 24 months. Generally, you must also meet the distance test. That is, your new main job location must be at least 50 miles farther from your former home than your old main job was from your former home. And if you do go to work for the first time, your new job must be at least 50 miles from your old home. So this distance that I moved, my old home was here and I moved there, that's not what the IRS is interested in with moving expenses. They're interested in, my old home was here and I've now moved to a new home. And how far was the commute from my old home to my old job? And how far would the commute have been from my old home to my new job? That's actually considered to be the distance of the move. In terms of the distance test, did I move the required distance of 50 miles? They're looking at the distance of the commute. How much did it increase? And they have a chart to help me explain that. That'll show you in just a second. There are exceptions to this first test under test number 2, the time test. You do not have to meet that time test, that is 39 weeks during the first 12 months and 78 weeks during the first 24 months, if you meet any of the following exceptions. Number 1, armed forces. You are in the armed forces and you moved because of a permanent change in duty station. Retirement. You moved to the United States because you retired. Survivors. You are the survivor of a person whose main job location at the time of death was outside of the United States. Death or disability. Your job at your new work location ends because of death or disability. Or number 5, you were transferred or laid off by your employer. If you are transferred for your employer's benefit or laid off for a reason other than willful misconduct, you must have obtained full-time employment and expected to meet the time test at the time you started the job. So here is the chart. This chart comes straight out of Pub 17. It would also be in IRS publications that relate to the moving expense deduction, but it's a chart that's not hard to find. Pub 17 has it. And so how the chart works, and we're looking at the distance test. We've got the old home that you used to live in. We call that your former residence. And we've got the old job that you used to work at. And how far was that drive from your old home to your old job? In this illustration, it's 3 miles. And then they show that, okay, well, I'm moving because I've got a new job. And that new job is 38 miles away. And IRS is saying, well, that's not far enough. 38 miles is not a big enough change in your commute, so we're not going to allow the deduction. But let's just suppose your former home, you've taken a new job, and it's 58 miles away. Well, 58 miles is more than 50 miles farther than 3 miles. And so you meet that 50-mile test. It would be okay to move to your new home so that you can take this new job, and you would be able to claim the moving expenses. I see a question from Carolyn Martin. What happens if a person does not meet the requirements but has an HSA? Are you allowed to take the deduction? Well, Carolyn, when you have an HSA, the only time you are allowed to put money in the HSA is because you meet the requirements for having an HSA. If you put money into an HSA when you are not allowed to because you are not covered by a high deductible plan or only by a high deductible plan, then that's a disqualifying contribution and you're not allowed to put the money in. You have to remove it. So there's no way to take a deduction when you're not meeting the requirement. And then number 3, moving expenses. If a military member retires, are they able to use the deduction if they're moving to another area? Well, a military person who retires per se, no. But if they retire from the military and immediately take up work somewhere else, which most military people retire, in their 40s or their early 50s, so they have a big career still ahead of them, they would typically, and I know this from experience, my husband was military, when you exit the military actually pays for your final move. They'll send you anywhere you want to go once. And so at least when my husband left the military, they paid for us to move to Portland, Oregon, where we've been ever since. Now, they may not have paid all of the expenses, so let's just say the military didn't pay every expense you had some additional expenses. Can you deduct those? Well, the answer would be yes if you take up a job in your new home and you expect that job to meet the 39-week test or the 78-week test, depending on the type of job you've got. How is the distance test met? I would use MapQuest. So Gordon is asking, how would you figure the distance test? I would MapQuest it. MapQuest is very handy for moving expenses because, as you'll see in a minute, you're allowed a standard mileage rate for moving expenses. And when my client tells me that they moved from Texas to Portland, I find their home address in Texas, I find their new home address in Portland, I MapQuest and it tells me the number of miles that they used. That's the mileage I use to figure their deductible expense. And I go with that. So I would not go with the crow flies. I would go with the mileage. Deductible moving expenses. Well, there's another question coming up. James Scott Haley, for the time test, do you take expenses from a previous year after the 39 weeks have been met? Okay. Moving expenses are claimed in the year that you pay them. You do not need to meet the 39-week rule at the time you claim the deduction, but you have to reasonably expect that you will meet the 39-week rule at the time you claim the deduction. So I'll use my own personal example. We moved from Virginia Beach, Virginia to Portland, Oregon. At the time we arrive in Portland, Oregon, we fully expect to meet the 78-week out of 2-year test because we're self-employed. We expect over the next 2 years we will remain employed. So we take the deduction in the year of the move, even though it's not physically possible for us to meet that 78-week test for another 2 years out. But if we move to Portland, Oregon, and our intention is to not work, we're just going to retire here, then obviously we don't expect to meet that 78-week test or 39-week test, whichever is appropriate, and so the moving expense is not allowed. I see another comment here. Does it matter that one was laid off in December but did not move until, say, April without a new job in the new location? Can the expense be deductible? Well, you're looking at the time you arrive in the new work location, not the time that you were fired. So when you arrive in your new home, where the new work location is, in the first year period that you've arrived there, do you expect to work 39 weeks from the time you arrive at your new home? So it isn't how long you were unemployed, it's how long you were employed after you arrived at your new home. And of course, you would claim expenses in the year you pay them. Deductible moving expenses. So we're assuming that you meet the tests, you've got expenses, what can you deduct? If you meet the requirements for claiming moving expenses, you can deduct reasonable expenses of moving your household goods and personal effects, including in-transit or foreign move storage expenses, and traveling, including lodging, but not the cost of meals to your new home. Allowable costs that you are allowed to claim include the cost of moving household goods, such as packing, crating, and transporting household goods and personal effects of yourself and members of your household from your old home to your new home. You can also claim the cost of storing and insuring household goods and personal effects within any period of 30 consecutive days after the day your things are moved from your former home, but before they are delivered to your new home. You can also claim the cost of connecting and disconnecting utilities required because you are moving your household goods, appliances, or personal effects. The cost of shipping your car to your new home. The cost of shipping your household pets to your new home. And the cost of moving household goods and personal effects from a place other than your former home to the extent that that cost does not exceed what it would have cost to move them from your old home. So let's just suppose, we'll just use military again because we were on that. You've got a military service member. They're leaving the military, and for the period of time that they've been in the military, they've had pretty small living quarters, and so they've had a storage unit where they're keeping a bunch of their stuff. And now they're moving. And they've got to have stuff shipped from storage, and they've also got to have stuff shipped from their home. And the IRS says you can claim the cost of moving your personal property from both the storage area and your personal home, but only to the extent it would have been the same as if it was all in your home and you moved it from there. So does the storage company charge you more to go and make that extra stop, or is it all inclusive and it doesn't make a difference? And to the extent it doesn't make a difference, the added cost associated with moving those extra items is allowed. Allowable travel costs are also deductible, and they include transportation and lodging for yourself and members of your household while traveling from your former home to your new home, including expenses for the day that you arrive. If you drive your car, you can claim the actual cost of gas and oil paid during your move, or you can claim a standard mileage allowance of 23 cents per mile. Lodging expenses in the area of your home within 1 day after the day you could no longer live in your former home because your furniture had been moved out. So the IRS says you've got the movers, they came, they emptied out your house, it's empty. So that night you go stay in a hotel. You're allowed that one night that you're in the hotel because your house no longer had furniture in it, but from that point they expect that you're on your way to your new home and you're hitting the road driving, or you're catching an airplane in the morning. You can deduct expenses for only one trip to your new home for yourself and members of your household. However, you do not have to travel together or at the same time. So, for example, you might send your family ahead of you and pay airfare for them, or put them in a car and send them on their way to move on ahead of you to arrive at the new home so that it's prepped and ready for the movers when they arrive. And then you stay behind. You handle a few extra activities. Maybe you have to finish up at work for a few days. But at some point later date, you travel separately. And the IRS says that that's okay. You don't have to travel together. But you could only deduct the cost of moving yourself once, one trip only. Okay, I see a question here. A person moves from India on immigration visa qualifies. The answer is foreign moves to the United States do qualify. Non-deductible moving expenses. You cannot claim a deduction for any of the following. These are the things people might ask for, but the answer is no. Any part of the purchase price of your new home, car tags, driver's license, expenses of buying or selling a home, expenses of getting or breaking a lease, expenses of home improvements that you make to help sell your home, or the loss on the sale of your home, losses from disposing of memberships in those clubs that you paid to join, meal expenses, mortgage penalties, pre-move house hunting expenses are not allowed, real estate taxes, refitting carpets and draperies, security deposits including any given up because of the move, storage charges except those incurred in transit and for foreign moves, temporary living expenses, and no double deductions. You cannot claim a moving deduction and a business expense deduction for the same expenses. So clearly, if you're self-employed and you move from one location to another location, some of the cost of the move might be associated with your business assets, the cost of shipping your office furniture or your equipment that you use in your business, and that would be deductible on Schedule C. You could not then turn around and also deduct those same costs on 3903. Password number 1 is now showing on the screen in front of you. Please write it down. Password number 1 is Canberra, C-A-N-B-E-R-R-A. Password number 1 is Canberra. Please write it down. So let's look now at the rules for employer-paid moving expenses. Your employer may pay all or part of the cost of your move for you. You're lucky if you have an employer that will pay it for you because moving is very expensive. You may only claim a deduction for allowable expenses that exceed the amounts that your employer paid on your behalf. Non-deductible moving expenses that are paid by your employer on your behalf are considered to be a taxable fringe benefit. If your employer paid non-deductible moving expenses for you, your employer must include the cost of those non-deductible expenses in your income. You have to pay tax on those benefits, and I see this all the time. If you are in any kind of a community that has large employers or affluent employers who are paying for high-end workers, they'll pay a lot of money to move those workers around. They might pay Travel expenses for a worker to come for an interview. When they hire that worker, they may give them a sign-on bonus. They may give that worker all kinds of incentives to make the move. But not all of those incentives are going to be tax-free to that employee. And when an incentive is given to an employee or a benefit is given to the employee that is not non-taxable under the law, then that employer has to gross up the employee's W-2 and that employee has to pay tax on it. Types of things that an employer might pay for an employee, that are commonly paid by employers for employees, include housing hunting expenses, real estate sales expenses. So you sell your home, the real estate commission is 6%. On top of that, you have to pay title charges and other closing costs. They add up. And some employers are willing to pay those. Temporary living expenses are also frequently paid by employers, as well as the cost of meals while traveling and living in temporary quarters. Employers who pay these kinds of non-deductible moving expenses for their employees will often give the employee more money again, more than the moving pay. They'll give them extra money in addition to that. This added pay is used to pay the extra taxes that the employee is going to owe because of the gross up. So let's just suppose your employer gives you $10,000 of non-deductible moving expenses and your rate of tax is 40%. Well, they give you $10,000 of expenses that you now have to pay $4,000 on. And the employer says, well, we'll give you the $4,000 to pay the tax you owe on the $10,000. But now you also owe tax on the $4,000, so I guess we'll have to give you $6,000 to pay the taxes you will owe on $16,000, and hopefully you come out at a wash. And I've had a number of clients over time confused by all those calculations, but the intent of the employer is to help them break even and not come out with less money than they should. So how are taxable reimbursements reported on the employee's W-2? Well, the employer is going to smack them right there in box 1. Whatever amount of income they normally would have had for the year in box 1, you're just going to add to it. And in my illustration where I said $16,000 is given to pay $10,000 of moving expenses, the $16,000 would then be included on the W-2 as box 1 income. Now, if an employer pays non-taxable moving expenses, in other words, moving expenses that would be deductible by the employee if the employee paid them directly, then that employer does not include the reimbursement in box 1 or the direct payment in box 1. So for example, if you have an employer that pays to pack and ship all of your household belongings from a home in New York to a new home in Massachusetts, that is going to be a non-taxable benefit to the employee, and it's fully deductible by the employer. But the employer will make an indication on the employee's W-2 with a code P how much was paid for that move. And any amount that the employer paid would be an amount that that employee is not able to deduct themselves. And that should make sense. Now, although non-taxable moving expenses reimbursements are reported in box 12 with a code P, it is sometimes the case that an employer will provide reimbursement without entering the amount of the reimbursement on the W-2. Therefore, the preparer should interview the client to determine if there was unreported employer reimbursements when calculating the deductible expenses and reimbursements to enter on the 3903. So it's not uncommon for employers to not know enough about tax law to know they're supposed to report those reimbursements on the W-2 with a code P. So the employer may have done nothing of that kind even though they should have. Therefore, as a tax preparer, you should be on top of that situation. You're interviewing your client says they moved for a job, and it may come up voluntarily on the part of the employee that their employer paid their expenses for them. Well, if their employer paid their expenses for them, there should be a code P, but if there isn't a code P, it doesn't mean that the expenses are deductible to the employee. It means you're going to need to figure out how much the employee's expenses exceeded that reimbursement, and you'll only claim the difference, of course. Now, here's an illustration. On January 1, 2012, Johnny Mover was hired by TJ Sports. TJ Sports reimbursed Johnny all costs of relocating from his home in Texas to his new home in Washington as follows. $3,000 of deductible moving expenses were paid by TJ Sports. TJ Sports also paid $8,000 of non-deductible moving expenses. And TJ Sports also paid another $4,500 for Johnny as a payroll increase to compensate Johnny for the income tax and Social Security and Medicare taxes he's going to owe on the $8,000 of non-deductible expenses that TJ Sports paid for him. Johnny's annual salary from TJ Sports is $75,000. And assuming he was hired and started work on January 1, he worked for the full year and got that $75,000 of wage. However, because of the additional gross up this additional $8,000 plus $4,500 or $12,500 has been added to his pay. And so the amount being reported on his W-2 is going to be $87,500. This $3,000 of expense up here that TJ Sports paid for Johnny is deductible. Therefore, it is not included in Box 1, but it is reported on Box 12 with the code P so that Johnny and you as his tax preparer can identify how much was reimbursed that was not taxable. So that concludes the discussion of moving expenses. Just see if there's any more questions here. If the employer pays non-deductible expenses but does not report those expenses, can a person report those and pay those taxes? If an employer paid non-deductible expenses for you and they were required to gross them up on your W-2, technically you should notify your employer of the omission because the employer has just issued an incorrect W-2 and needs to fix it. So they should be going back and correcting the W-2, correcting all the 941 payroll reports, and doing the proper withholdings. That's what should happen. Now, if you're a very honest employee and the employer refuses to do that and says, just forget it, the employee could voluntarily report that income on the front page of their tax return and even attach an additional form for paying their share of the Social Security and Medicare taxes. But I honestly have just never seen that happen. In 20 years, I'm not aware of that happening. I'm sure it has happened, but I haven't had to deal with it. Okay, moving on. The next topic of the day is the deductible part of self-employment tax. And this should be a relatively simple topic, but I thought I would use the concept of the deductible part of self-employment tax to introduce a little bit of a lecture on the self-employment tax directly so that we can learn a little bit about when and how to figure self-employment tax. And then once we've figured our self-employment tax, then there's the deductible part that we claim on the front page of Form 1040 as an adjustment to income. So you must pay self-employment tax on net income from self-employment. All of the following sources of income are subject to self-employment tax. Schedule F or C income that you earn as a sole proprietor. Partnership income of a general partner and guaranteed payments to a partner reported on Form 1065 or Schedule K1. Wages or self-employment earnings as a church minister, or non-employee compensation reported as other income on Form 1040, line 21. In most cases, you will need to attach Schedule SE and pay self-employment tax on income reported in Box 3 of the Form 1099 Miscellaneous. So 1099 Miscellaneous has two key boxes that affect self-employed people. Actually, there's more than that. There's a fishing box. There's a healthcare payments box that can also trigger self-employment. But typically, most of the time when we look at a 1099 Miscellaneous, we're triggered for the need for self-employment tax when there's an entry in Box 7. That's non-employee compensation. Sometimes payments are reported in Box 3 that really should have been entered in Box 7. And so Box 3 does not necessarily trigger self-employment tax. It could be that there's an entry in Box 3 that would not trigger self-employment tax. For example, you won a prize, free trip to Hawaii. A free trip to Hawaii is a prize. It's reportable, and 1099 Miscellaneous is used to report it, but it's not subject to self-employment tax because it's not a payment for service. But sometimes the amount in Box 3 is a payment for service, and that's simply what this line is saying, is if the amount in Box 3 is a payment for service, then you should report that payment and pay self-employment tax on it. Okay, so what's the purpose of the self-employment tax? Self-employment tax is the equivalent of Social Security and Medicare taxes payable on employee wages. For many self-employed individuals, self-employment tax exceeds income taxes for amounts that are payable in a tax year. Without advanced planning and proper prepayment of taxes through withholdings or quarterly estimates, self-employment tax liabilities can create a large balance due when an individual files his or her return. If you've been in this business any length of time at all, you've probably already had clients who file self-employed and find out they owe a boatload of money. And more often than not, the majority of what they owe is entirely because of the self-employment tax. In fact, if you think about it, the self-employment tax is 15.3% most of the time. I've got that number right here. Most of the time, self-employment tax is 15.3%. Most taxpayers don't pay 15.3% income tax. They're typically paying a good portion of their tax at much lower rates than 15.3%. because they're allowed deductions for their family and their mortgages and so on. And so typically most people are in a bracket that is less than 15%, but the self-employment tax of 15% is assessed on all of their income with no other deductions allowed, and so it really hammers people. So how do you figure or get to that 15.3% tax? Where does it come from? Well, the amount of Social Security and Medicare tax attributable to wage and self-employment compensation are essentially the same. How these taxes are assessed and who pays them is the primary difference. If you are an employee, your employer is required to withhold 6.2% of your earnings to pay Social Security tax and 1.45% of your earnings to pay Medicare tax. For 2011 and 2012 only, we had a payroll tax holiday. For those 2 years, everyone's W-2s showed 2% less withholding for Social Security and Medicare tax. I don't know about you, but I certainly had a lot of clients this tax season comment to me as soon as we got into the new year, 2013, that boy, their taxes went up this year. And I laughed because, well, actually, I guess they did go up, but what really happened is that a temporary payroll tax cut ended. So your taxes are right back where they would have been had that payroll tax holiday never happened. And so I think for the first time, some people kind of had their eyes opened as to how much that little 2% payroll tax really did help them out, because it did amount to a significant amount of money. So therefore, for 2011 and 2012, the self-employment tax was 13.3%. But prior to 2011 and for 2013 and future years, payroll tax has returned to 15.3%. And this is how you get the amount. The employee share of Medicare tax is 1.45%. For 2011 and 12, the employee share of Social Security tax is 4.2%, but in most years it's actually 6.2%. And the employer share of Medicare tax is 1.45%, and the employer share of Social Security tax is 6.2%. So for 2012, you add those up and you get 13.3%, and for 2013, you'll get 15.3%. Now, if you are self-employed, you're required to pay both the employer share and the employee share of those two taxes. And if you were an employer and you were paying payroll tax on wages that you pay to your employees, you would be able to deduct the payroll tax you're paying on your employees. That employer share of 1.45% and 6.2%, employers get to deduct that as a business expense. So if you are self-employed, IRS says you can deduct that part too. But you can't deduct the full amount that you wouldn't be allowed a deduction for anyway, because if you were an employee and you were issued a W-2, that tax is withheld and you don't get any deductions for it. But the other half that you're paying only because you're self-employed, you do get to deduct that. So if you are self-employed, you must pay both the employer and the employee part of the tax. You figure the tax by completing Schedule SE, and then once you've figured the tax, you enter it on Form 1040, line 56. Now, how do you go about deducting that employer equivalent part of the SE tax? Well, again, you also use Schedule SE to figure the employer portion that is deductible to you. I thought I'd throw in a little bit of a tidbit here on ministers. I don't really teach a class specifically on ministers, nor do I teach a class specifically on military, but I do throw into my courses where it seems a good point the odd tidbit on these specialized categories. Ministers are a specialized category when it comes to self-employment tax because they get to pay it whether they're self-employed or not. And if you are a minister of a church, your earnings for the services you perform in your capacity as a minister are subject to self-employment tax even if you perform these services as an employee of that church. There is an exemption possibility from the SE tax if you are a member of a recognized religious sect or a division of a recognized religious sect. You can apply for an exemption from the payment of Social Security and Medicare taxes on both your self-employment income and the wages that you earn from an employer who also has an exemption. To do that, you file Form 4029 with the IRS. Now, here's the deal. If you're claiming an exemption from Social Security tax, you're doing so on religious grounds. You're saying, I don't believe in that particular system. I don't think I should have to pay into it, nor do I think I should ever be entitled to anything from it. And any minister I've ever had who've asked me about opting out of the Social Security tax, as soon as they've learned that by opting out they'd never be entitled to receive it when they need it, they change their minds and they go ahead and pay it. So from my standpoint, I've never had a minister who filed this form. but I would expect there's probably regions of the country where there might be groups of people who do file them regularly. Self-employment tax on minister income. All of the following must be included in gross income when figuring the amount of income that is subject to self-employment tax. Salaries and fees for your ministerial services. Offerings you receive for marriages, baptisms, funerals, masses, etc. The value of meals and lodging provided to you, your spouse, and your dependents for your employer's convenience. The fair rental value of a parsonage provided to you, including the cost of utilities that are furnished by your employer, and any rental allowance, including amounts for payments of utilities that are paid to you. Also, any amount that a church pays towards your income tax or SE tax other than amounts withheld from your salary are going to be subject to the self-employment tax. So here's an illustration of how it works. Now, in a perfect world, you have a church that understands the rules that apply to ministers, and the church issues a correct W-2. I frequently run across ministers who have churches that don't know what they're doing, little churches with accountants that don't know the rules, and so I see some ministers who are issued 1099 miscellaneouses by their churches. I see other ministers who are issued W-2s and the church paid their self-employment tax for them or did withholdings for Social Security and Medicare tax. Both of those are incorrect, and if you go and read the instructions that the IRS provides for ministers, the IRS specifically states that the church may not pay Social Security or Medicare tax for a minister. And so a minister's W-2 should look like the one that you see right here, where we have box 1 showing wage income of the minister, and the church can go ahead and hold out federal income tax, but there shouldn't be any other amounts entered for Social Security and Medicare withholding. So this W-2 here looks like it should. But here's our character in our story. His name is Pastor Roy Rogers, and he receives an annual salary of $50,000 as a full-time minister. The $50,000 includes $10,000 that is designated as a parson allowance to pay rent and utilities for his home. Pastor Rogers is not exempt from self-employment tax. He must include $50,000, which is the $40,000 of wage plus the $10,000 of parsonage, when figuring his net earnings for self-employment purposes. The $10,000 parsonage allowance is exempt from income tax, but it is not exempt from self-employment tax. Thus, Pastor Rogers will report the following amounts on his tax return. $40,000 is line 7 wages, and $50,000 of self-employment wages will be entered on his Schedule SE. And he will figure the deductible portion of his self-employment tax and then enter that on line 27 of the 1040. So here we have Pastor Roy Rogers' W-2 showing $10,000 of federal withholding. And when I've got ministers with churches that are really on the ball, it's normal to see a huge number in box 12, or box 2, pardon me. The W-2 will show a reasonable sum in box 1, which is the compensation of the minister, and then it'll have this enormous number in box 2 because that minister is trying to get enough withholding in place to cover all of the Social Security and Medicare tax that they owe. Our software also provides this worksheet, and it's a rather interesting worksheet. I haven't got any employee expenses for Pastor Rogers, but if he were to have employee expenses, he's only allowed to deduct 80% of those expenses because 20% of his income for services as a minister is excluded from income. So IRS says when you do have a minister, you were supposed to do a worksheet to figure out what portion of his ministerial expenses, if he has ministerial expenses, would be deductible to him on Schedule A. And in this case, 20% of his ministerial expenses would not be deductible, but he doesn't have any ministerial expenses. So we simply show the amount of wage income he has, the amount of parsonage income he has. We get $50,000 that's ultimately going to carry to his Schedule SE. And here we have plunked that right down on line 2. And if you read the fine print for line 2, it says net profit or loss from Schedule C or income from a Schedule K1 with box 14 code A, and ministers and members of religious orders. Enter your income here. And that's where we've got the $50,000. We then do a computation where we multiply 50,000 by 92.35%. We get 46,175. We then take 46,175 and we multiply that by the rate of self-employment tax. For 2012, that's 13.3%, and we get a number, 6141. Now, for most years, the deductible part of the self-employment tax is a simple number. It's half the self-employment tax, or 50% of the self-employment tax. But for 2011 and 2012, it's a little bit different. because the employer portion of the self-employment tax is actually more than half of the self-employment tax. So for both 2011 and 2012, the deductible part is actually 57.51% of the total. So for 2012, Roy Rogers' deduction is going to be $35.32, and he's going to carry that to the front of his Form 1040 and enter it there. So move over to his 1040, and on page 1 of the 1040, we show his wage income of $40,000. On line 27, we enter the deductible part of the self-employment tax, attach a Schedule SE, and we enter $35.32 on the line as his deduction. And of course, the self-employment tax appears on line 56 and is added to his income on page 2 of his form. And if you look at his overall tax return here, we have page 1 with $40,000 of wage. We claim that adjustment to income, and it brings his adjusted gross income down to $36,468. He then claims his standard deduction of $59.50, his exemption of $3,800. He then has taxable income of $26,718. He goes to the tax tables and figures his tax, 35.74%. But his self-employment tax is $61.41. Just going 3 times 2, you get 6. The self-employment tax isn't double his other tax, but it's close to double his other tax. It pulls his overall liability up to $9,715. He had $10,000 withheld, and that's just enough. He ends up with a $285 refund. And the next topic is self-employed SEP simple and qualified plans. Linda, shouldn't the parsonage allowance be in box 14? That's possible. Parsonage can be included in box 14, but it is not required. It depends on the payroll service. So box 14, just going off the top of my head, on a W-2, this box is essentially reserved for employer use, and employers can use it for anything they want, and they could use it to show the housing if they wanted. So self-employed SEP simple and qualified plans, the deduction for those are entered on line 28 of the Form 1040. And I don't know about you, but for me, deductions that get entered on line 28 have been some of the most intimidating that I've run across as a tax practitioner. It's kind of a scary line. It requires some knowledge about some fairly advanced tax law concepts that are well beyond the purview of most tax preparers. And quite frankly, most of our tax clients don't participate in those plans, so we can safely ignore them. So back to our self-employed SEP and simple qualified plans. What I've done for you today here in this class is the best job I can of pulling out the most important key elements of the different types of plans that a self-employed person might participate in, and how to go about calculating the deduction that they would be allowed to claim. It's not meant to teach you everything that there is to know, because these plans are complicated. There's extensive publications that you have to read through with multiple illustrations. I've just pulled out the basics and created a few illustrations on how to calculate these deductions. I don't know if you're aware of it, but the IRS has enrolled agents. You should be aware of that. But they also have something called an enrolled actuary or an enrolled retirement plan agent. It's possible to specialize just in retirement plans, and that's not me. So I've put together the basics for you, and the basics are pretty much what I understand, but I've got a pretty good handle on the basics. You can deduct contributions you make to a retirement plan that you set up for your employees. If you are a sole proprietor, you can deduct contributions you make to the plan for yourself. And how much you are allowed to contribute to a plan depends on the type of plan that you have. You can choose between a variety of retirement plans, and these are summarized in this table that I've inserted in your manual, and the table comes directly from IRS Publication 560. You can see that the IRS has identified the plans on this table as being SEP, Simple IRA, and Simple 401k, Qualified Plan, including a defined contribution plan, and a Qualified Plan, including a defined benefit plan. Up here it says the last date you are allowed to contribute to each of these plans, the maximum amount you are allowed to contribute to each of these plans, the maximum deduction you can claim for contributions to the plans, and when you must set the plan up to be able to make contributions and then deduct them. SEPs are the simplest, and they're the simplest to set up and the easiest to follow the rules for, you could say. The last date for making a contribution to a SEP plan is the due date of the employer's return, including extensions. The maximum contribution is the smaller of $50,000 or 25% of the participant's compensation, which is limited to $250,000 a year. The maximum deduction is 25% of all participants' compensation. And when can you set the plan up? At any time up to the due date of the employer's return, including extensions. Simple plans. You can make salary contributions or salary reduction contributions within 30 days of the end of the month for which the contributions are to be made. And matching or non-elective contributions that are made by the employer can be made by the due date of the employer's return, including extensions. For employee contributions through salary reduction, the maximum amount that an employee can contribute to a simple plan through salary reduction is $11,500 or $14,000 if they're age 50 or older. What is the maximum deduction? The same as the maximum contribution. And when do you set the plan up? Well, you have to set it up anytime between January 1 and October 1 of the year for which the plan will apply. So if you're trying to set up a plan to which you can make contributions and claim a deduction for 2012, then the plan would need to be set up by October 1 of 2012. Qualified plan, which is a defined contribution plan, elective deferral rules. You have to put money in by the due date of the employer's return, including extensions. And for employer return, the money purchase or profit sharing is due by the due date of the return, including extensions. How much can you contribute? The elective deferral is up to $17,000 or $22,500 if age 50 or older. Employer contribution, money purchase, the smaller of $50,000 or 100% of the participant's compensation. And for profit sharing, it is the smaller of $50,000 or 100% of the participant's compensation. And again, what is the maximum deduction? 25% of all participants' compensation plus the amount of elective deferrals made. When to set up the plan? You have to have it in place at the end of the year. You can't set it up after the year's over. Qualified defined benefit plans have different rules again. Now, when to set up the plan, as I said, the key thing here is that if you have a small business owner who has some extra money and they want to make a contribution to your retirement plan and then claim a deduction for it on their tax return, they can do that well into 2013. In fact, if you've got a Schedule C filer who wants to set up and put money into a SEP plan and then take a deduction for it on their 2012 return, they technically have all the way until October of 2013 to do that. Several months away yet. So that's a really good deal, kind of a sweet deal for sole proprietors to take advantage of. And that concludes our look at the SEP Simple IRA line of the 1040 form. We're going to move on to a couple of simpler concepts, or at least one simpler concept, which is the self-employed health insurance deduction. But even that, there's plenty to talk about. And that's what's coming up next. Line 29. Certain self-employed individuals may be able to claim an above-the-line deduction for health insurance premiums. The deduction is available to sole proprietors who are filing Schedule C or F. It's also available to statutory employees who are independent contractors but receive a Form W-2 that has the statutory employee box checked, and they report their expenses on Schedule C. General partners who receive guaranteed payments allocable to health insurance expenses that are reported on Schedule K, and S corporation shareholders for whom the corporation made health insurance payments that are reported to the shareholder on a Form W-2. If you are self-employed, you may be able to deduct the amount paid for health insurance for yourself, your spouse, your dependents, and your child who is under age 27 at the end of 2012, even if that child is not your dependent. Self-employed health insurance plan rules. The rules apply on how the insurance plan of your business is established, and follow these guidelines to make sure the plan qualifies. Now, there was a period of time there where the IRS seemed to be saying that if the plan was not established under the name of the company or the name of the business, that you weren't allowed to claim the self-employed health insurance deduction. And this really started being a focus, or maybe even a center point of alarm for the tax preparation community. Certainly it was for me, right around 2005. The IRS was making some rulings that were causing people to be concerned that they wouldn't be allowed to claim the self-employed health insurance deduction if they had a plan in their own name instead of in the name of their business. And quite frankly, from a personal standpoint, as a small business owner, I would look at that and say, well, if I set up a company plan, the exact same coverage is more than if I set it up individually. So why should I be forced to go with the higher amount just to be able to claim this deduction? So I was upset about it. But then it came to light that maybe people were analyzing it too hard, and so the IRS actually announced some procedures or some definitions of what it means to have a plan established in the name of the business, or have the insurance plan established for the business. So these are the guidelines that exist today, and they're pretty relaxed. They're not at all stringent as far as I'm concerned. If you follow these guidelines, then the plan should qualify. If you're self-employed and you file Schedule C, CEZ, or F, the policy can be set up either in your name directly or in your business name. It doesn't matter. You're still going to be allowed the deduction. If you're a partner, the policy can be in the name of the partnership, or it can be in your name. If you're the partner and the policy is in your name or the partnership's name, either of you can pay the premiums. So if you pay the premiums, it's allowed. If the partnership pays the premiums, it's allowed. If the policy is in your name and you pay the premiums, the partnership, however, must reimburse you and include those premiums as income on your Schedule K-1. That's an important point, because you could have easily a partnership, and each of the partners in that partnership separately go their own ways and set up health insurance plans for themselves. And they don't involve the partnership in that in any way. And if they do that way, then they're not going to be allowed to claim the self-employed health insurance deduction. That is the one way you can create a problem for yourself. With a Schedule C, that would be okay. You don't have to run it through the Schedule C. In fact, you can't run it through the Schedule C for yourself. It's simply not allowed. But for a partnership, partners in a partnership that want to be able to claim an above-the-line deduction for their self-employed health insurance premiums need to run the money through the partnership, even if the health insurance plan is in their own name. So if you set up a health insurance plan in your own name, you need to go to the partnership and ask the partnership either to pay the premiums for you directly, or you need to have the partnership reimburse you. Whichever way the partnership does it is fine. But what the partnership must then do is identify the fact that those premiums were paid for the partner on the Schedule K-1. For S Corporation shareholders, there's also a very specific rule about how it needs to be done. If you're an S Corporation shareholder, the policy can be in your name or the S Corporation's name, and either of you can pay the premiums. If the policy is in your name and you pay the premiums yourself, the S Corporation must reimburse you and then include the premiums as wage income on your Form W-2. So going back up to our earlier illustration where we had a W-2, I'm just going to find one. There's one. We had one for Roy Rogers here. Here's a W-2. This is just a not Roy Rogers W-2. We're looking at a generic W-2 here. Box 1, if you're a shareholder in an S corporation and that corporation reimburses you for your health insurance premiums or pays them directly, either way, whatever amount that corporation paid for your health insurance, it's going to be reported on your W-2 as wage income. And to the extent that the health insurance premiums have been included as wage income on your tax return, you're then going to be allowed to claim the self-employed health insurance deduction. If your employer, which is yourself, if you own the S corporation, right? Technically speaking, the S corporation exists as a separate entity from you, and you are in control of it. And you need to be in control of it to such an extent that through payroll, you do your W-2 correctly. And that W-2 needs to indicate or include in Box 1 the wages you received that are for reimbursement of your health insurance premiums. Now, the interesting thing is that when you are an owner in an S corporation, any amount that the corporation pays towards your health insurance premiums is not subject to the Social Security or Medicare taxes. So it's possible, and actually should be the case, that Box 1 would be higher than either Boxes 3 or 5 in that situation. Let's just suppose, I'll put my drawing key up here, that you are an owner in an S corporation and your normal rate of pay that you give yourself annually is $30,000, but you have the corporation reimburse you for $10,000 worth of health insurance premiums, then what would happen is your W-2 would have $40,000 in Box 1, and it would have $30,000 in each of Boxes 3 and 5. And you would have to pay Social Security and Medicare taxes on the $30,000 of base wage that you pay yourself, but you would not have to pay Social Security or Medicare taxes on the additional amount that was included in your Box 1 wages because it was a reimbursement for health insurance. So S corporation shareholders, you should be looking for a W-2 that is kind of lopsided, different than normal. Now, if this person also had a 401k plan, that would add even more complexity to it. But we're just going to stop here and say $40,000, of which $10,000 is for self-employed health insurance. If the formula works like this, then what would happen is the S corporation would claim a deduction for officer compensation of $40,000. The owner of the company, or owner compensation of $40,000, the owner of the company reports $40,000 as wage income, and then $10,000 comes off as a self-employed health insurance deduction. So that's how it should look for S corporation shareholders, and there are not too many tax practitioners out there who get that part right. So if you've got that one down, you've got something pretty valuable in place, because IRS auditors know the rules, and if you don't know the rules, you could get your clients in trouble. Get back to where I was here. So we were at the bottom of this page right here. If you're an S corporation shareholder, the policy can be in your name or the S corporation's name, and either of you can pay the premiums. If the policy is in your name and you pay the premiums, the S corporation must reimburse you and include those premiums as wage income on your Form W-2. Okay, so we've got the rules about how to go about paying the premiums, and if you follow those rules, do the premiums actually qualify for the deduction? You may not deduct the cost of health insurance premiums you paid in certain situations. Most of the time you would be able to, but there are some situations where you simply cannot do it. You cannot deduct premiums that you paid for any months that you were eligible to participate in a health plan subsidized by your or your spouse's employer, or the employer of either your dependent or your child who was under age 27 at the end of 2012. So you're married, you have a spouse. You're not covered by any other health insurance plan, which is why you took one out for yourself. Or at least that should be the case, except your spouse, their employer does have a plan, and you could sign up for that plan. And by signing up for that plan, then you would be able to receive some health insurance benefits through your spouse's employer. If that's the case, then if you take out a plan on your own and choose to participate in your own plan rather than your spouse's plan, you're not going to be eligible to claim the self-employed health insurance deduction. Similarly, let's suppose you have a child who's age 25, and you've chosen to get health insurance for them because maybe the health insurance they have through the job just isn't that wonderful. So you say, hey, I'm going to take out some extra health insurance for you. You are allowed to do that, but you're not going to be allowed to claim a self-employed health insurance deduction for it, because while you were paying premiums for your child through your business, your child already had health insurance premiums being paid for them through their employer. So anytime you are covered by a health insurance plan or eligible to be covered by a health insurance plan of your spouse, you're not allowed to claim the self-employed health insurance deduction. And similarly, if you have your regular job and you're provided with health insurance benefits through your regular job, and then you're also self-employed and you choose to pay more for health insurance on your own, you're not going to be allowed that deduction either, because you were eligible to participate in your own plan at work. Also, you're not allowed to claim a self-employed health insurance deduction for any amounts paid from the retirement plan distributions that were non-taxable because you are a retired public safety officer, or any amounts that you included on Form 8885 for the health coverage tax credit, or any qualified health insurance premiums you paid to the U.S. Treasury, or any health coverage tax credit advance payments shown in Box 1 of Form 1099H. Those restrictions are not going to apply to too many people. The big one is this one right here. If you have the ability to participate in any other form of health insurance plan through you or your spouse's employer, you're not allowed to claim the self-employed health insurance deduction. Schedule C and F filers. Self-employed individuals may not deduct health insurance premiums paid for themselves or their family on Schedule C. Although both Schedule C and F provide a line for claiming the cost of health insurance premiums paid, that line is used only to claim the cost of premiums that are paid for employees of the sole proprietor and not the sole proprietor him or herself. However, there is an important distinction, and that distinction is that it is possible for a sole proprietor who's filing Schedule C or F to hire their spouse to work for them. So let's just suppose you're a tax preparer and you have an income tax service, and you work it year-round, and during tax season you hire your husband to come in and work for you to prepare tax returns or to help out around the office, and so you pay your spouse. You could take out a health insurance plan for your spouse and pay for that for your spouse and deduct that on your tax return on Schedule C. because that would be health insurance premiums being paid for your employee, provided, of course, you're paying your spouse on a W-2. Partnership Form 1065 and S Corporation Form 1120S, 2% or more shareholder filers. In IRS Headliner 163, which was published in May 15, 2006, the IRS announced its position on the deductibility of health insurance premiums paid for partners in partnerships and 2% or more shareholders in S corporations. Then IRS Notice 2008-1 came out, and it provided additional clarification, comments, and examples of acceptable ways 2% or more shareholders can receive health insurance benefits from their corporation for purposes of the self-employed health insurance deduction. And I've already described them to you a few minutes ago, but we're going to go over them again because this is basically pulling a summary from these notices. The summary in these documents is as follows. Partners and 2% or more S corporation shareholders may claim a self-employed health insurance deduction only if the partnership or S corporation maintains a group health insurance plan. Health insurance premiums paid by partnerships and S corporations on behalf of any partner or a 2% or more shareholder must be included in the taxable compensation of the partner or 2% or more shareholders. Amounts a partnership pays for the health insurance premiums of the partners are deductible by the partnership as guaranteed payments and included as income from guaranteed payments on Schedule K-1 that is issued by the partnership to the partners. Now, we have some illustrations of those types of reporting documents in our course on Introduction to S Corporations and LLCs. I don't have them here, but in that course we will have those. Amounts an S Corporation pays for health insurance premiums of 2% or more shareholders are deducted by the S Corporation as compensation of the officers. Remember I said the corporation will put the cost of the health insurance premiums into Box 1 wages of the shareholder employee and claim a deduction that way. It will not claim a health insurance deduction for the shareholder owner. It will claim a wage deduction for wages paid to that shareholder. So for Form 1065, if you are a partner in a partnership and you have that partnership reimburse you for or pay your health insurance premiums for you, then that partnership needs to issue you a Schedule K, and in Box 14 they should put a Code A. If you are a partner in a partnership and the partnership paid health insurance premiums for you, the cost of the premiums must be included on your Schedule K-1 as a guaranteed payment that is reported in Box 10. And then in addition to that, your K-1 should indicate in Box 14 with a Code A what portion of the guaranteed payments in Box 1 are for the health insurance premiums. Assuming you meet the requirements for claiming the self-employed health insurance deduction, you would then enter the amount on the Schedule K in Box 14 with a Code A. You would carry that to the Form 1040 and enter it on line 29. For Form 1120S filers, you go to the W-2. The W-2 may not actually break out what portion of Box 1 wages is for health insurance premiums, so you're going to need to make sure that Box 1 does include health insurance premiums. And if it doesn't, then that shareholder should go back to the corporation and have the corporation amend the W-2. Make sure that that gross up occurs. And if the corporation did it backwards, then what could have happened is the corporation may have claimed a health insurance deduction rather than a wage deduction for wages paid, and the whole corporate return would have to be amended. That could be kind of a mess, and probably not uncommon mess either. There is a self-employed health insurance deduction worksheet, and the IRS provides this worksheet to help you determine the amount of the health insurance deduction that you are allowed to claim. The worksheet also provides guidance on when health insurance premiums can be deducted, and it applies limits. It limits the amount of long-term care insurance premiums that you can deduct, as well as the overall amount of the deduction that can be claimed based on your net earnings from self-employment. For individuals filing C or F, that is Schedule C or F, and partners who receive self-employment income from a partnership that is reported on Schedule K-1, the deduction is limited to the net profit from self-employment earnings minus the deductions for the deductible part of the self-employment tax, as well as contributions for the sole proprietor's benefit to a simple or qualified plan. So when you look at this worksheet, and I don't fill this worksheet out for you today, I put it in here, but if you were to read it, you can see that the very first item listed on at the top, enter the total amount paid in 2012 for health insurance premiums coverage established under your business for 2012 for you, your spouse, and your dependents. Your insurance can also cover your child who was under age 27 at the end of 2012, even if that child was not your dependent. But do not include the following. And the first one on the list is amounts for any months that you are eligible to participate in a health plan subsidized by your or your spouse's employer or the employer of either your dependent or your child who was under the age of 27 at the end of 2012. Then it goes on to apply limits for long-term care insurance coverage. You can claim a self-employed health insurance deduction for long-term care premiums that you paid, but it's limited by your age. So you have to look to how much your client paid for long-term care insurance. And if they paid more for long-term care insurance than is allowed based on their age, then the deduction is going to be limited to the amount you see here for their age. It then goes on and looks at amounts that have been contributed to the SEP or simple plans. It looks at any amount that might have been excluded on Form 2555. So as I said, it's there for you to read, but the purpose of that worksheet is to guide you through figuring all of that. So with that, let's move on with the next topic of the day. And the next topic of the day is going to be the penalty on early withdrawal of savings. I can't think of a more mundane and simple adjustment to income than this one, and yet I still see tax preparers or run across tax preparers who don't know how to claim this deduction. So yeah, we're going to cover it. This particular deduction is claimed on line 30 of your tax return. If you withdraw funds early from a deferred interest account that has a maturity of 1 year or less, you may be subjected to an early withdrawal penalty that you have to pay to the financial institution when you take your money out. Early withdrawal penalties are usually reported in Box 2 of Form 1099 INT. You can claim a full deduction for the early withdrawal penalty as an adjustment to income on the front of your 1040, line 30, even if the penalty is greater than the interest that you earned. Well, here is a 1099 INT. And remember earlier when I showed you that 1099 SA for health savings account distributions, and I said that most of the time when your clients get a 1099 for an SA account, they look like that? Well, when it comes to 1099 INTs, they almost never look like the 1099 INT you're seeing here. This is the IRS's official format for 1099 INT, and what you need to remember as a tax practitioner is what the boxes mean. If your customer has a 1099 INT with a number in the equivalent of Box 2, it may just say 1099 INT substitute, line 1, ordinary interest $100, line 2, early withdrawal penalty $20, and you're just supposed to know what that means. It's expected that you know what it means, and what it means is that the amount that is for line 2 would be entered on line 30 of the 1040 as a deduction, and you just enter it there. Whatever amount's in Box 2, automatically you put it on line 30. It doesn't take any more thought than that. But whatever amount is in Box 1 still is entered as interest income, and you never take Box 1 and reduce it by Box 2. Instead, you enter Box 1 in full on line 8 where it belongs of the 1040, and you enter the amount in Box 2 in full on line 30. Now we're moving on to alimony. Alimony is a little bit more complicated topic. It's a favorite topic of the C exam. If you are studying for the enrolled agent exam, they're bound to ask you questions on alimony. And actually today I will throw up an alimony question for you and see how you do on it. You can deduct alimony you paid even if you do not itemize your deductions. You claim a deduction for alimony as an adjustment to income on line 31A of your tax return, and on the line you are also asked to provide your Social Security number. That number is required. You enter it on line 31B, and a $50 penalty can apply, or the deduction could be disallowed if you fail to put the number there. The rules for deducting alimony are the same as the rules for including alimony on your return. Refer to IRS Publication 17, pages 131 through 134 for more information on the deductibility of alimony. Today we're basically looking at the taxability of alimony. If the alimony is taxable to you, then it is deductible to the person paying it, and vice versa. If the person paying it is allowed to claim a deduction for it, that means it's taxable to you. So that's why the rules are the same. So what is alimony? And alimony is often frequently referred to as spousal support. If you pay your former spouse alimony under a divorce or separation agreement, you can deduct payments you made to your former spouse during 2012 as an adjustment to income on your return. To be alimony, the payment must meet certain requirements, and to determine if the alimony payments are deductible, all of the following rules apply. Number 1, the payments are required by a divorce or separation instrument. You cannot file a joint return with the ex-spouse to whom you are paying the alimony. The payment must be in cash, including check or money order. Your divorce or separate maintenance decree must not state that the payment is not alimony. You and your ex-spouse to whom you pay the alimony cannot live together. There is no liability to make any payment in cash or property after the death of the recipient spouse, and the payment is not treated as child support. Child support is probably the single biggest issue to come up. Most of the time when my clients ask me about whether or not they can deduct alimony, my mind is circling around whether or not it's actually child support. Some states alimony is quite common. For example, California, alimony is a more common situation. In Oregon, where I live, very, very few of my clients ever pay or receive alimony. Virtually all of the money going back and forth is child support. So you'll have to look to what you see in your own state. But your job as a practitioner is to establish whether or not the payment that is being paid by your client is alimony. And if it is alimony, they can claim a deduction for it. But if it is not alimony, they're not allowed to deduct it. If your divorce or separation instrument specifically designates a payment as child support or treats the payment as child support, then the payment is not alimony. A payment is specifically treated as child support to the extent that the payment is reduced upon the happening of a contingency relating to your child, such as the child becomes unemployed or dies or leaves the household, leaves school, marries, or reaches a specified age or income level, or at a time that can clearly be associated with a contingency. Here is an example where we have a payment that is alimony. Steve and Sandra Ballard are divorced. Sandra has custody of their 2 children. The divorce decree states that Steve shall pay Sandra $1,500 per month. The decree does not stipulate that any of the payment is contingent on either of the children. The entire payment is therefore considered alimony, and Steve can deduct alimony payments on his Form 1040, line 31A. In example number 2, we have a payment that is partially alimony. George's divorce decree states that he must pay his ex-spouse the following monthly amounts: $600 of spousal support and $200 of child support for each of their 2 children. George may deduct $7,200 of spousal support as alimony on his tax return. The $4,800 of child support that George pays his former spouse is not taxable to her, nor is it deductible to George on his return. Child support shall always be considered as having been paid before alimony. So if a divorce instrument orders the payment of alimony and child support shall always be treated as paid first. If you make payments during the year, but you're not able to pay the full amount that you owe for the year, then all of the payments you made for the year are going to be allocated to child support. And once the child support has been deemed to be paid in full, then you look to see how much additional was paid above and beyond that, and the additional amount is the amount that would be considered alimony. And here's an example where the child support is paid first. John and Jane are divorced. Their divorce decree states that John must pay Jane the following monthly amounts: $600 of alimony and $500 of child support. During 2012, John falls behind on his payments. He made total payments to Jane of $8,000 during the year. He can deduct $2,000 as alimony on his return as an adjustment to income, but the first $6,000 of the $8,000 that he paid is going to go to the child support, and only the excess is for alimony. The IRS has this chart, and this chart basically summarizes all of the alimony rules in one tight place. It says in this column that a payment is alimony if all of the following are true, but it's not alimony if any of the following are true. So under the all of the following are true, the payments are required by a divorce or separation instrument. The payer and the recipient spouse do not file a joint return. The payment is in cash, including checks or money orders. The payment is not designated in the instrument as not alimony. The spouses are legally separated by a decree of divorce or separate maintenance and are not members of the same household. The payments are not required after the death of the recipient spouse. The payment is not treated as child support. And if you have a payment that meets these criteria, then the payment is deductible by the person paying it, and it is included in income of the recipient. But if any of the following apply, then the payment is not alimony. The payment is not required by a divorce or separation instrument, or the payer and the recipient spouse file a joint return with each other, or the payment is not in cash, or it is a non-cash property settlement, or it is the spouse's part of community income or to keep up the payer's property. The payment is designated in the instrument as not being alimony, then of course it wouldn't be alimony. The spouse is legally separated under a decree of divorce or separate maintenance are members of the same household. The payments are required after the death of the recipient spouse. The payment is treated as child support. If any of these items are the case, then the payment is not alimony. It's not deductible by the person paying it, and it's not taxable to the person who is receiving it. I see a comment here from Carolyn who asks, if a client pays the alimony and the child support to a court-based payment center to be paid out, does this still count? The answer is yes, it would be, but typically, I'm not experienced with court payment centers. I am accustomed to seeing garnishments going on and basically parents who have not been meeting their obligations for making those payments. And I would be very, very careful to make sure that all of the child support is accounted for. When you're looking at all of the payment that went out in a year, did any of the payment that went out this year account for back payments of child support from earlier years? Because it's theoretically possible you could have, just say, a father who has not paid any alimony or child support for 5 years. And so a court order comes down, garnishments start happening, or he's forced to make payments to this court center. And you're going to have to account for how much back child support is due, make sure all of the child support has been caught up on, and then anything above and beyond child support, then it could start to go to alimony. And then I see something, what if the spouse lives in another country, not citizen? If he sent money through money transfer, is it considered alimony? Well, it's going to be considered alimony if it's part of a divorce decree and it's ordered under the divorce decree and it meets all of the tests for being alimony. So if it meets all of these criteria, then it would be alimony, whether the spouse is in the country or not. Individual retirement account, line 32, is the next topic of the day, and we'll be on this topic for quite a while. IRAs are, I wish I could say a lot of people put money into their traditional IRAs, but that's not usually the case. Most people rely on their 401k plans. I don't have a lot of people that really take advantage of the IRA deduction. But when you do have someone who does want to take advantage of the IRA deduction, you definitely need to be aware of what the rules are. And they're important because it is easy in your tax software to override safety measures that are in place on the computer. And when you do that, the computer may give a deduction where it's not supposed to. So if you follow the instructions that your computer provides on how to calculate the deduction for individual IRA account contributions, the computer can probably arrive at the right amount. But our computer software, Drake software, actually allows a direct entry for IRA deductions, and it also offers a worksheet for figuring the IRA deduction. And if you make a direct entry, the computer assumes that that direct entry is allowed, and it gives it. And so we always caution our staff not to use direct entry screens on Drake software and rather go to the worksheet to make sure that the worksheet is being filled out correctly and Form 88606 is being triggered if it's necessary. So how do you know, or how do you compute the amount of an allowable IRA deduction? Well, here's the rules, and we're going to be on them for quite some time. An individual retirement account is a trust or custodial account that is set up inside of the United States for the exclusive benefit of you or your beneficiaries. The account is created by a written document, and the document must show that the account meets all of the following requirements. The trustee or custodian must be a bank, a federally insured credit union, a savings and loan association, or an entity approved by the IRS to act as a trustee or custodian. The trustee or custodian generally cannot accept contributions of more than the deductible amount for the year. However, rollover contributions and employer contributions to a simplified employee pension can be more than that amount. Contributions except for rollover contributions must be in cash. You must have a non-forfeitable right to the amount in the account at all times. Money in your account cannot be used to buy life insurance. Assets in your account cannot be combined with other property except in a common trust fund for common investment fund. You must start receiving distributions by April 1st of the year following the year in which you reach age 70.5. What is an IRA? An IRA is a personal savings plan that offers you tax incentives to set aside money for your retirement or education. Originally, there was only one kind of IRA. However, in the 1990s, new kinds of IRAs were created, including Roth IRAs and educational IRAs. An educational IRA allows you to set aside money for certain educational expenses. Contribution limits. You can contribute money, cash, check, or money order to your IRA, and you can contribute the lesser of your compensation for the year, which is included in your income, or $5,000 if under age 50 in 2012, or $6,000 if you were age 50 or older in 2012. If you contribute to a Roth, you must reduce your allowable contribution to your traditional IRA by the amount that you put into the Roth. In other words, they share that same $5,000 ceiling. Married filers, if you are married and you file a joint return, you can make an additional spousal contribution that is limited to the lesser of $5,000 if your spouse was under age 50, or $6,000 if your spouse was age 50 or older. The total compensation includable in the gross income of both spouses for the year. So what this is saying is your contribution is limited to the lesser of $5,000 for each of you, or the total compensation included in the income of both of you for the year. Now, for a married couple where both of the filers are under age 50, the maximum contribution and deduction is $10,000. If one is age 50 and the other is not, then it increases to $11,000. And if both of you are age 50 or older, the maximum contribution amount moves to $12,000, or your compensation, whichever is less. When can you make a contribution? You can contribute money to your traditional or Roth IRA at any time during the year, or by the due date of your return for that year, not including extensions. And for 2012, that was April 15 of 2013. So, of course, we might have had a few clients rushing out to make IRA contributions so they could claim deductions on their tax return by the end of tax season. Catch-up contributions in certain employer bankruptcy. The provision for additional catch-up contributions in certain employer bankruptcies that applied in earlier years does not apply to 2010 or any later year. Traditional IRA. The traditional IRA is what we're going to be talking about most of today. There is also the Roth IRA, but when it comes to the Roth IRA, we're not typically dealing with how much our deduction is going to be, right? Because you can't deduct contributions to a Roth anyway. So the purpose of the adjustment to income line on the front page of the tax return is to claim a deduction for contributions you make to a traditional IRA and not a Roth IRA. But because we are on the topic of IRAs, I will later in the class get into Roth IRAs a little bit. Traditional IRA is the original IRA that was approved by the government to allow taxpayers the option of saving for retirement inside of a tax-deferred account that is owned and controlled by the taxpayer. A traditional IRA is any IRA that is not a Roth IRA, simple IRA, or education IRA. In addition, an IRA is not a 401k plan. Earnings generated by money you invest in your IRA are tax-deferred. This means you do not pay tax on the earnings until you withdraw them from your IRA. What are the advantages of investing in a traditional IRA? Well, there's two primary advantages. Firstly, if you qualify, you may be able to deduct contributions you make to your IRA on Form 1040 as an adjustment to income. And generally, the funds that are inside your IRA are not taxed until you withdraw them. So theoretically, if you have money in a savings account, every year that the income that's generated in that savings account or that brokerage account is taxable to you. You have to put it on your tax return, you have to include it in income, and you have to pay tax on it. But any money that's inside your IRA earning income, you just ignore the income. It's not put on your tax return. You don't address that as income at all until you take the money out of the plan. Who can make contributions to a traditional IRA? You can set up and make contributions to a traditional IRA if you are under age 70.5 and you or your spouse, if you are filing a joint return, had compensation during the year that you must include in your income. Now, for most of the concepts that we come across with IRS dealing with income, we're looking at unearned income versus earned income, and earned income comes from working. But when we get to this IRA concept, instead of using earned income, IRS instead introduces this word compensation. And the reason they introduce the word compensation is it includes something more than just earned income. It also includes two other types of income. One of them is alimony, and the other is military differential pay and non-taxable combat pay. So compensation for purposes of the IRA deduction includes earned income from wages, commissions, and self-employment. It also includes alimony and separate maintenance payments received, as well as military differential pay and non-taxable combat pay. Compensation does not include interest, dividends, rental or investment income, pension or annuity income, deferred compensation payments postponed from an earlier year, income from a partnership unless you provided services for the partnership that were income producing, conservation reserve program payments, or any other amounts other than combat pay that you were able to exclude from your income, such as by using the foreign earned income exclusion. Non-taxable combat pay. If you were a member of the U.S. Armed Forces, compensation includes any non-taxable combat pay that you received. This amount should be reported in Box 12 of your Form W-2 with the code Q. So theoretically, I haven't seen a combat pay W-2 here in Oregon. We don't have much for military bases, so we don't see a lot of military W-2s here, unlike Virginia Beach when I lived there where the entire community was military. But theoretically, it's possible, I imagine, that you could have a W-2 for a service member who was in Afghanistan the entire year. All of their pay is combat pay, none of it's taxable. So they have zero income on their W-2. And can they make a contribution to an IRA? And the answer is yes, because for purposes of the IRA contribution, they are allowed to consider non-taxable combat pay as compensation and still make the contribution to their IRA. So the IRA compensation summary rules are as follows. Compensation includes wages, salaries, etc., commissions, self-employment income, alimony and separate maintenance, and military differential pay. Compensation does not include, however, earnings and profits from property, interest and dividend income, pension or annuity income, deferred compensation, or income from certain partnerships. IRA deduction is limited by income. Your allowable deduction depends on you or your spouse's modified adjusted gross income and whether you are covered by a pension plan at work. Those are the two key elements. I cannot put any more into my IRA than I have compensation. So I figure out how much compensation I have. If my compensation is $50,000, I'm fine. I can put my $5,000 in there, no problem. If my compensation for the year is only $2,000, $2,000 is all I can put into my IRA. So that's the one side of the IRA. How much am I allowed to put in there? The other side of it is, how much am I allowed to deduct? It's potentially possible that you put more into your IRA than you are allowed to deduct. And how do you determine when your deduction is going to be limited? Well, your IRA deduction can be limited if you are covered by a pension plan at work and you have modified adjusted gross income above a certain level. So that's where most tax practitioners get confused, and that's where we're going to spend quite a bit of time today. Note also that if you contribute any money to a Roth IRA, you must reduce your IRA deduction by the amount you contributed to your Roth IRA. So if you put $5,000 into a Roth, you're done. There is no IRA deduction that you can claim. If you put some money into your traditional IRA and some into your Roth, then you might be allowed a deduction for the amount you put into your traditional. And here's an example where we have contributions that are limited because they were made to both a Roth and a traditional. Bilbo, age 42, has adjusted gross income of $65,000. He contributed $3,000 to his Roth IRA during the year, and he also has until April 15th to contribute the final $2,000. And he can put the final $2,000 either into a Roth or a traditional account. And it doesn't matter which. If he puts it into a traditional account, he could claim a deduction for it. If he puts it into a Roth account, he gets no deduction for it. Modified adjusted gross income for traditional purposes, for calculating whether or not you are allowed to claim a deduction for your IRA contribution, is determined by looking at the adjusted gross income shown on line 37 of your tax return and then adding back into income the following amounts. Any IRA deduction you might have tried to claim, the student loan interest deduction, the tuition and fees deduction, the domestic production activities deduction, the foreign earned income exclusion, the exclusion for qualified bond interest used for qualified higher education expenses, and the exclusion of employer-paid adoption expenses shown on Form 8839. You should refer to Publication 17, page 122 for a worksheet, and it's 17-1 to figure your modified AGI. I'm seeing here, if a person receives VA disability, would their compensation be counted? I don't think VA disability is a form of compensation. It's not one of the ones listed. Combat pay and wages reported on the W-2 and self-employment and alimony. Those are the ones that qualify. I don't know of anything that disability, non-taxable disability would fit in there. Now you might have received, there are some people who receive disability pay under a disability payment program that's issued on a W-2 that possibly could, as long as it's not deferred compensation. But you're seeing here, these are the types, and I'm not seeing anything in there that says disability pay. All right, moving on. Let's look. We've come up with all of the things that affect your modified adjusted gross income. Now we're looking at how much of a deduction can you claim for money you put into your traditional IRA if you are not covered by an employer plan at work. So what's an employer plan at work? Well, it's a 401k, a 403b, it's a SEP plan, it's a simple plan. Any of those mean that you have an employer plan at work. And typically when you have an employer plan at work, your employer will check the retirement plan box on your W-2. So if we look at a W-2, I'm just going to flash to the back of the manual where I have one. For classwork assignment number 3, I did put a W-2 in here for George Kelly. And you can see on his W-2, he's got the retirement plan box checked. If that box is checked, your little alarm bell should be working when it comes to the IRA deduction. George has got wage income of $102,000, and he's got a retirement plan at work. So you should be concerned about that as a tax preparer in terms of whether or not an IRA deduction will be allowed. So if you have W-2s for your client and none of the pension plan boxes are checked, it's probably safe to assume that they are not covered by a pension plan at work. So if you are not covered by a pension plan at work, you are allowed a full deduction up to the maximum amount that you're allowed to put into your IRA for the year. So if you determine based on your level of compensation that you are able to contribute $5,000 to your IRA and you're not covered by a pension plan at work, you're allowed to deduct all $5,000. If you're age 50 or older, you can put up to $6,000 and deduct all of it. If you are married filing joint and you and your spouse both contribute to traditional IRAs and neither of you is covered by a pension plan at work, you could earn $1 million and you'd still be allowed to deduct the full $5,000 each or $6,000 each if one or both of you are age 65 or older. But if you have no pension plan at work, but your spouse does have a pension plan at work, then you need to look at some different rules. If your spouse is covered by a pension plan at work and you are not, your deduction may be limited as follows. If you file a joint return with your spouse, you can claim a full deduction for yourself if your modified adjusted gross income is $173,000 or less. If your modified adjusted gross income is greater than 173 but less than 183, then you are in a phase-out range. And if you look at the range here, it's a $10,000 phase-out range. 173 to 183, that's a $10,000 range. If your income puts you halfway between 173 and 183, it would mean you're 50% into the phase-out range, and you would be allowed a 50% of the maximum deduction. That's what it would mean. And if your income hits $183,000, you are not covered by a pension plan, but your spouse is, and you file a joint return with your spouse, neither of you are allowed a deduction for contributions to your IRAs. If you file separately from your spouse, and your spouse has a pension plan at work, but you do not, your deduction is phased out between $0 and $10,000. So you're not allowed much of a deduction at all, if any. Now, if you are covered by a pension plan at work, then you're going to have to look at a separate phase-out limit based on you, not your spouse. If you are covered by a pension plan at work, your deduction is limited as follows. Firstly, you look to your filing status, and if your filing status is single or head of household, you can claim a full deduction if your modified AGI is $58,000 or less. If your AGI is $58,000 or more, then you move into a phase-out range, and when your income hits $68,000, you earn too much and you're not allowed to claim an IRA deduction. Now, if your filing status is married filing joint and you are covered by a pension plan, it doesn't matter whether your spouse is or not. You're filing a joint return, you have a pension plan at your work. Then you look to your joint tax return and look at your modified adjusted gross income. If it's under $92,000, then no phase-out applies. But if it's 92 to 112, a phase-out will apply, and if it's over 112,000, you're not allowed an IRA deduction at all. So let's look at the effect of modified AGI deduction if you are covered by a retirement plan at work. This is a table that comes out of Pub 17. And you can find it on pages 121 and 122 of that publication. If your filing status is single or head of household, and you are covered by a retirement plan at work, and your income is $58,000 or less, you're allowed a full deduction. If your income is more than 58 but less than 68, you're allowed a partial deduction. And if your income is $68,000 or more, you are not allowed to claim any deduction. If you are filing a joint return and you are covered by a pension plan at work and your income is $92,000 or less, you're allowed a full deduction. If your income is more than $92,000 but less than $112,000, you get a partial deduction, and if your income hits $112,000, you are allowed no deduction. It doesn't mean that you can't put money into your IRA. You can. You're just not allowed to claim a deduction for it. That's an important distinction. And then finally, married filing separately. If you are covered by a pension plan at work and your income is less than $10,000, you are allowed a partial deduction. If you are covered by a pension plan at work but your income hits $10,000 or more, you're allowed no deduction at all. Let's compare this first table here with this second table. This is the effect of your modified adjusted gross income on your deduction when you are not covered by a pension plan at work. If your filing status is single, head of household, or qualifying widow, it doesn't matter how much you earn. You can earn $1 million, $10 million. You're still allowed a full deduction because you don't have a pension plan at work. If you are married filing jointly or separately and your spouse is not covered by a pension plan at work, same rule, you can earn any amount of money and you're allowed a full deduction. But if you are married filing jointly and you have a spouse who is covered by a pension plan at work, then your deduction is going to be allowed in full as long as your modified adjusted gross income is less than $173,000. And when the income hits $173,000, you move into the phase-out range, and then when your income hits $183,000, you are allowed no deduction at all. If you are married filing separately and you have a spouse who is covered by a pension plan at work, then your deduction phases out between $0 and $10,000. So how do you go about claiming the deduction for IRA contributions to a traditional IRA? Well, you figure your allowable deduction using the IRA deduction worksheet for line 32, and then you claim your deduction on Form 1040, line 32. This particular deduction is also allowed on the short Form 1040A, and if you claim it there, you would enter it on line 17. If your contributions exceed the maximum deductible amount that you are allowed to claim a deduction for, then you must attach Form 8606 to your return. And we have an illustration here, which is how you figure a partial IRA deduction. David is age 45, and Jane, age 40, are filing a joint return. David and Jane Peggotty. They're filing a joint return, and they're both under age 50, so they're not going to be allowed $6,000. They're limited to $5,000 each. Jane is a homemaker, and David earned $192,000 of wage. He is covered by an employer pension plan at his job. Well, that tells you right then Jane is a homemaker, isn't covered by a pension plan at work because she doesn't have a job, right? She's a homemaker. So David earned the only income of the family, $192,000. He's covered by a pension plan on his job. Jane is not. And David paid $15,000 of alimony during the year. The Peggottys will also contribute $5,000 each to their respective IRAs. What is the amount of their IRA deduction? Well, here is the worksheet. And the worksheet has two columns. There's your IRA and your spouse's IRA. When you're looking at the front of the tax return, your IRA would be whoever is the taxpayer, and the spouse's IRA would be whoever is listed on the tax return as the spouse. Now, I'm kind of giving a hint here to people who are going to maybe take this course as a self-paced course and do one of the homework assignments. One of the homework assignments I have, the taxpayer is a woman. And therefore, the woman can be listed first on the tax return. It doesn't need to be a man who's listed first. And there are lots of people I've run across over the years that somehow think the man's name needs to be listed first on the tax return. That's not the case. And whenever you take an assignment from Pacific Northwest Tax School, the first name listed in the problem will be the taxpayer, and the second name listed in the problem will always be the spouse. And you need to follow that pattern when you move over to the IRA deduction worksheet, because trust me, your software does. The software, whoever you've listed as the taxpayer, is going to be listed first on the IRA deduction worksheet, and whoever is listed as the spouse will be listed second on the IRA deduction worksheet. And the very first line you come to says, were you covered by a pension plan at work? It's asking, was the taxpayer on the tax return covered by a pension plan at work? And in this case, we know that David was. So we check yes for box 1A. And was the spouse covered by a pension plan at work? Jane, she's a homemaker. No, she doesn't have a pension plan at work. Okay, we've got past that first line, 1A and 1B. Now we move on to line 2. And on line 2, it says, enter the amount shown below that applies to you. For married filing jointly, enter $112,000 in both columns. But if you checked no on either line 1A or 1B, and we did, we checked it on 1B, enter $183,000 for the person who is not covered by a plan. Well, that's Jane. She's not covered by a plan. We then go on to line 3, and it says, enter the amount from Form 1040, line 22. That's $192,000. And then on line 4, we enter any adjustments that are allowed for purposes of calculating modified adjusted gross income. When we go through this list, which I am going to read to you, we have all of the items that are allowed to be a reduction to modified AGI for purposes of calculating this IRA deduction. They include educator expenses, certain expenses of reservists, performing artists, and government officials, health savings account deduction, moving expense deduction, the deductible part of the self-employment tax, self-employed SEP simple and qualified plan deduction, self-employed health insurance deduction, the penalty on early withdrawal of savings, alimony, and Archer MSA. Now, did David and Jane have any of those? The answer is yes. In the wording of the problem, I told you that David paid $15,000 of alimony for the year, so we've entered that on line 4. And why does that matter? Well, it's going to be a reduction to income, and it's going to take the income from the $192,000 down to $177,000. So David's modified AGI of $177,000 is entered on line 5A, and the same amount is entered on line 5B for Jane. Now we're doing some math. We're going to look to see, is the amount on 2A smaller than the amount on 5A? And yes, it is. So the amount we carry to line 6 is 0. Right now, we already have figured out that although David is going to put $5,000 into his IRA, he's not allowed to claim a deduction for any of it because his income is too high. But we go over to Jane, her starting point of $183,000. After we subtract out the $15,000 of alimony, her modified adjusted gross income is $177,000. Well, that's less than $183,000, and we do the math. $183,000 minus $177,000 is $6,000. We're interested in this $6,000 because it's simply telling us how far into the phase-out range that Jane is. Remember, I told you that the phase-out range for a married filing joint return is between $173,000 and $183,000 if you are the spouse of a person who has a pension plan but you do not. So how far into that phase-out range are we? Well, we're $6,000 into that phase-out range. That's what the math is telling us. And so what that means is that only a part of Jane's contribution is going to be deductible. And the rest of the worksheet is used to figure out how much that is. So line 6A is 2A minus 5A, and it shows that David is not allowed a deduction. Line 2B minus line 5B shows that Jane is allowed a partial deduction. If the amount on line 6B were $10,000 or more, Jane would be allowed a full deduction. But the amount on line 6B is $6,000, so we know Jane is only going to be allowed a partial deduction. $6,000 is 60% of $10,000, and that means that Jane will be allowed 60% of the maximum IRA deduction amount. And if the maximum amount is $5,000, 60% of $5,000 is $3,000. That's going to be the amount of the deduction. But the worksheet isn't that logical, if you ask me. It's more confusing. Instead, what it has you do is it says take the amount from line 6B, go over to page 2, and then it says if you checked no on either line 1A or 1B, then multiply the amount for the person not covered by a pension plan by 50% and enter that number here. You still get $3,000, but that's how the math works. Now the next step is to say how much did you actually make a contribution for during the year, because obviously you can't claim a deduction if you never made a contribution. And so we then say, okay, David contributed $5,000, Jane contributed $5,000, and we're going to get the lesser of the deductible amount or the actual amount contributed. And then in this case, that's $3,000. So this box down at the bottom is simply another way of explaining what the worksheet just did. And when you understand the purpose of a worksheet, you could basically throw the worksheet aside and not even use it at all. And today, just to test your brains, I've got a series of Classwork assignments that, depending on the amount of time we have, I'm going to throw up for you and let you work your way through in terms of being able to figure the amount of IRA deduction a person is allowed to claim without ever bothering with the worksheet. The IRA deduction worksheet is used to calculate the allowable IRA deduction for a person who is covered by a pension plan at work or who is married to a person who has a pension plan at work. The worksheet applies phase-outs for each filing status based on income and provides space for computing your modified AGI. Use of the worksheet is not required because it is possible to figure the deduction without the worksheet. And if I were to figure Pegady's deduction without the worksheet, I would do it like this. We take the Pegady's modified AGI of $177,000 to determine how far into the phase-out range that the Pegady's are. David's phase-out range is 92 to 112. His income is way higher than that, so he's not allowed a deduction. That was simple. And Jane's phase-out range is 173 to 183, and we can look at 183 minus 177 and see that we are only partway into the phase-out range. So the phase-out range for a married filer is 173 to 183 if that filer is not covered by a pension plan at work, but the spouse is. And that's a $10,000 phase-out range. So then we take 183, we subtract out 177, and we get $6,000. That means that Jane will be allowed 60% of the maximum deduction, and that gives us $3,000. Reporting non-deductible contributions to your IRA. Okay, so we figured out that we're only allowed to enter $3,000 as a deduction on the 1040, even though the Pegady's put $10,000 into their IRA. But what about the other $7,000? What happens to it? Well, it is reportable, and we have to put it somewhere on the return, and where we put it is Form 8606. So if your IRA deduction is limited or not allowed, you must file Form 8606 and attach it to your tax return. You use the form to figure the deductible portion of your contribution and to report your IRA basis to the IRS. If you are not required to file a tax return, you should still file Form 8606 if you made a non-deductible contribution to your traditional IRA. And here is an illustration. Continuing on with David and Jane. David and Jane each contributed $5,000 to their IRAs for the year, and their modified adjusted gross income is $177,000. David's basis for 2011 and earlier years is $10,000, and Jane's basis for earlier years is $2,000. Since David is covered by a pension plan at work and his modified adjusted gross income is greater than $112,000, his IRA contribution is not deductible. So he's going to attach Form 8606 to his return. On line 1, he's going to enter the amount of non-deductible contribution that he made. On line 2, he enters his basis from earlier years, which is $10,000. He adds 1 to 2, and he gets $15,000. And $15,000 is his new basis in his IRA. Now, he doesn't fill any of these other lines out because they are only used if he takes a distribution, and he did not do that. Moving on to the next illustration, continued, we have an 8606 for Jane because Jane and her husband, they don't share the same IRA account. Each of them has their own separate individual IRA accounts, so each of them would fill out separate 8606 forms. So Jane's not covered by a pension plan at work, but she's partway into the phase-out. She is allowed a deduction of $3,000, but she contributed $5,000. That means she's got $2,000 she couldn't deduct. That $2,000 is going to get entered on line 1 of 8606. On line 2, she enters her basis from earlier years, which I told you was $2,000. And on line 3, she adds those up. $4,000 becomes her basis for 2012 and earlier years. And the amount that she is allowed to deduct, we're going to carry that over and enter it on line 32. $3,000 is the amount of her deduction. I see a question here. Carolyn, if a person has a retirement plan at work but the spouse does not, are they still able to deduct? Well, I just think I showed you here in the Pegady's illustration that they are allowed to deduct, but they're only allowed to deduct the amount put into Jane's account because any amount put into her husband's account is phased out. He earns too much to claim a deduction for amounts put into his account, but Jane, amounts put into her account, she is allowed to deduct. Thanks. All right, acts that result in penalties. So when you have an IRA, you are required to behave yourself. You're allowed to use that IRA only for making contributions to save for your retirement, and there are a number of things that you might try to do with respect to that IRA, and if you do them, they can get you into trouble. You can be penalized if you engage in any of the following actions relating to your IRA. Number 1, your IRA invests in collectibles. That Superman comic book collection that I'd love to own, I cannot buy it with my IRA or I'm going to be in trouble. If you take an early distribution from your IRA, that's also going to result in a penalty. Or you allow excess amounts to accumulate in your IRA. Or you borrow money from your IRA. Or you buy property for personal use with IRA funds. Or you sell property to your IRA. You receive unreasonable compensation for managing your IRA. Or you use your IRA as collateral for a loan. There's also something called a qualified reservist distribution. A qualified reservist distribution is not subject to the additional tax on early distributions. What would happen is a person is a reservist, they're called to active duty, and during the period that they're on active duty, they might need to take some money out of their IRA or some other type of retirement account. And if they do that, they don't have to pay the normal penalties associated with that. It's called a qualified reservist distribution. A distribution you receive is a qualified reservist distribution if the following requirements are met. You were ordered or called to active duty after September 11, 2001. You were ordered or called to active duty for a period of more than 179 days or for an indefinite period of time because you were a member of a reserve component. The distribution is from an IRA or from amounts attributable to elective deferrals under a Section 401k or 403b plan or a similar arrangement. The distribution was made no earlier than the date of the order or call to active duty and no later than the close of that active duty period. Reserve component means you were a member of the Army National Guard, the Army Reserve, the Navy Reserve, the Marine Corps Reserve, the Air National Guard of the United States, the Air Force Reserve, the Coast Guard Reserve, or the Reserve Corps of the Public Health Service. Qualified reservist repayments go hand in hand with qualified reservist distributions. If you took a qualified reservist distribution, then you may be in a position where, hey, you've got some extra money later on and you want to put it back in. And the IRS says you can do that, even if it means you're putting more than the maximum amount normally allowed for contributions for the year. If you were a member of a reserve component and you were ordered or called to active duty after September 11, 2001, you may be able to contribute or repay to your IRA amounts equal to any qualified reservist distributions that you previously took. You can take these repayment contributions even if they would cause the total contributions to your IRA to be more than the general limit on your contributions. To be eligible to make these repayment contributions, you must have received a qualified reservist distribution from an IRA or from a Section 401k or 403p plan at some point during the period allowed. Your qualified reservist repayments cannot be more than your qualified reservist distributions. You cannot make these repayment contributions later than the date that is 2 years after your active duty period ends. You cannot deduct qualified reservist repayments. The repayment of a qualified reservist distribution does not affect the amount you are able to deduct as an IRA deduction. And if you repay a qualified reservist distribution, include the amount of the repayment and the non-deductible contribution on line 1 of Form 8606 as a non-deductible IRA contribution amount. So that's a tongue twister. Let's just see how it would all go together. We have an illustration here of a qualified reservist repayment. In an earlier year, Barclay, age 46, received a $3,000 qualified reservist distribution, which he repaid this year. His basis in all of his traditional SEP or simple IRAs on the end of 2011 was $10,000, and the value of his IRA on December 31 of 2012 was $40,000. I give you that information because you need it to fill out 8606, which we're about to do for Barclay. Barclay's 2012 IRA contribution limit is $5,000, and his modified AGI is $61,000. Barclay figures his allowable IRA deduction for 2012 as follows. The modified adjusted gross phase-out range for a single filer is 58 to 68. With his income at 61, he's partway into that range, so he's going to be allowed a partial deduction. Barclay's modified AGI of $61,000 is $3,000, 30% of the phase-out range. That means his allowable IRA deduction will be 30% of the maximum for his age. 30% of $5,000 is $3,500. So he will be allowed to claim an IRA deduction of $3,500 on line 32 of his Form 1040, but the qualified reservist repayment and the additional portion of his IRA contribution that takes him to $5,000 are non-deductible and need to be reported on Form 8606. So the deductible part of his IRA contribution is $3,500. He's going to enter that on the front page of his 1040 as an adjustment to income. He has the non-deductible part of that $5,000 contribution, and he also has the qualified reservist repayment of $3,000. $1,500 plus $3,000 is the amount that's non-deductible for the year, and he's going to enter that on line 1 of his Form 8606. On line 2, he enters his basis from earlier years of $10,000. On line 3, he enters $14,500 as his basis for 2012 and future years, and then it asks what was the value of all of your accounts at the end of the earlier year, $40,000, and we've entered that on line 6. Haven't given a third password yet, Leslie. Inherited IRAs. If you inherit a traditional IRA from a person who had a basis in the IRA because he or she made non-deductible contributions, that basis remains with the IRA. For inherited IRAs, there are special rules that apply, and they're different depending on whether you're a spouse of the decedent or a non-spouse of the decedent. If you are the decedent's spouse, you can choose to treat the IRA as a separate inherited IRA or as your own IRA. If you roll the funds over into your own IRA, you can combine the basis of your spouse's IRA with the basis of your own IRAs. If you choose to treat your spouse's IRA as your own IRA, you cannot take distributions from the IRA until you reach age 59 and a half. If you do not roll the IRA over or elect to be treated as the owner, you can take distributions from the plan before you reach age 59 and a half. For non-spouse beneficiaries, if you are not the spouse of the decedent, you cannot combine your basis in your inherited IRA with the basis you have in any of your own IRAs. And in fact, you are going to be required to begin taking distributions from that IRA called required minimum distributions on an annual basis. But those distributions are not subject to the 10% early distribution tax. Password number 2 is Breezy. B-R-E-E-Z-Y. Breezy. The next topic of the day is Roth IRAs. Rules for Roth IRAs and traditional IRAs are the same with the following exceptions. There is no age limit for contributing to a Roth IRA. There is no deduction allowed for any money you put into a Roth IRA, and you do not report the Roth IRA contribution on your tax return in most cases. The income limits apply to IRAs just as they do to traditional IRAs, but with traditional IRAs, you're only worried about whether or not you have a pension plan at work. With Roth IRAs, it doesn't matter whether you have a pension plan at work. What matters is whether you earn too much to be allowed to make a contribution. And you hit a phase-out range on your ability to make a contribution when your income is $110,000 for single head of household or married filing separately. If your income hits $110,000 but it's less than $125,000, you are allowed to make a partial contribution to your Roth account. When your income hits $125,000, you're not allowed to make a contribution to your Roth account. So you can see here that the phase-out range for single head of household and married filing separately is a $15,000 phase-out range rather than the $10,000 phase-out range we were looking at or the $20,000 phase-out range we were looking at for traditional contributions. The phase-out range for a married filing joint filer is $173,000 to $183,000, and for a married filing separate filer, it's between $0 and $10,000. You are not required to take a distribution from your Roth IRA when you reach age 70 and a half. With a traditional IRA and with other types of retirement accounts, distributions become mandatory when you reach age 70 and a half. But with Roth IRAs, that's not the case. Qualified distributions from your Roth IRA are not taxable. A qualified distribution is any distribution that occurs 5 years after the first year in which you make a contribution and is made on or after the date you reach age 59 and a half, or because you are disabled, or to the beneficiary of your estate after your death, or to pay certain qualified first-time homebuyer amounts. Any of those would be an exception to the penalty, but not an exception to taxability on the taxable portion. Most of the time, distributions from Roth IRAs are not taxed at all, but if you do have a non-qualifying distribution, then income from that distribution can be taxable and it can be subject to a penalty. Converting from a traditional IRA to a Roth IRA. Now remember I just showed you that there's a limit on how much money you can make and still contribute to a Roth IRA. Well, the way around that problem is if you earn too much to contribute to a Roth and you also earn enough money that you're not allowed to claim an IRA deduction when you have a pension plan at work, what you can do is contribute money to your traditional IRA and then roll it into a Roth IRA. And that's a way around that income threshold rule. It used to be the case that rollovers weren't allowed when your income was above a certain amount, but that rule went away beginning with tax year 2008. And now, regardless of your income, you are allowed to do a rollover, a direct rollover from a traditional IRA or any other form of retirement account into your Roth account. The rollover is subject to the same rules that apply to converting a traditional IRA to a Roth IRA when you do it from any of these other types of accounts. Typically, a rollover from a non-IRA account or from an IRA account to a Roth account could create taxable income. However, if you're in a situation where you earn too much to be allowed to claim a deduction for contributions you make to a traditional IRA, you could put money into the traditional IRA and then immediately roll it into the Roth, and in doing so have no taxable amount to report with the rollover, but 8606 is still required to be filed in those situations. There's a question that says, can a beneficiary of a decedent's IRA not take ownership claim but still contribute to that IRA? No. An inherited IRA of a beneficiary who is not a spouse is an inherited IRA. You're not allowed to contribute money to it, and you're not ever allowed to treat it as your own IRA. You only ever treat it as a beneficiary IRA. And there is a required minimum distribution that must be done each year. If there is a basis in that account, you are allowed to use that basis to figure the taxability of the distributions. But the distributions are mandatory based on minimum distribution requirements, and you cannot treat that IRA as your own. That means you cannot make contributions to it. Coverdell Education and Savings Account, or ESA. There's really no line on the tax form for making a contribution to a Coverdell, but since we're on the concept or the discussion point of IRAs, I figured I'd throw the Coverdell in here just to say we hit it at some point somewhere in our 1040 series. An education savings account is a trust or custodial account that is created to pay the qualified higher education expenses of a beneficiary who is under the age of 18 or is a special needs beneficiary. Amounts in the account grow tax-free until they are distributed, and the following rules apply to education savings accounts. The account must be organized in the United States, and it must be designated as a Coverdell ESA when it is created. Any individual can contribute money to a Coverdell ESA. However, the total amount contributed to any one beneficiary during the year cannot exceed $2,000. The amount you can contribute phases out when your modified adjusted gross income is greater than the amount shown here for your filing status. $95,000 to $100,000 for all filing statuses except joint, where the phase-out range doubles. Distributions made to pay qualified education expenses of the beneficiary are generally tax-free. Qualified expenses include the cost of attending elementary, secondary, undergraduate, or graduate studies, as well as qualified room and board, and you would need to look at Pub 970 for descriptions of what's qualified for room and board expenses. A 10% additional tax applies to distributions that are greater than the qualified educational expense of the beneficiary. You are allowed to roll over assets from one beneficiary's Coverdell ESA to the Coverdell ESA of certain family members. And generally, assets remaining in that ESA are required to be distributed when that beneficiary dies or reaches age 30. The due date for contributing to an ESA is the due date for the filing of your return, not including extensions. So Coverdell ESAs, there's no deduction allowed when you put money in. I can't really put a litmus test out there and say how many of my clients have them, but there's really not much incentive to put money into them because the limit of $2,000 a year, I suppose if you start when your child is born, you might save enough for it to matter. There's another kind of education savings account which is called a Section 529 plan, which is the state college savings plans, and they don't have limits on them based on income or anything else other than the amount necessary for your child's tuition. And so I find lots of clients take advantage of those, but I don't see too many doing Coverdell ESAs. But there are a few out there, and when they do pull the money out, they can use it to pay for education, including elementary school education. The next item in line is the student loan interest deduction claimed on line 33. This was one of those deductions that was due to phase out for 2012, but it was resurrected at the last minute, and it is now in place for 2012, and probably 13 as well. Qualified student loan interest to be deductible, the interest on a student loan must meet certain criteria, including the student loan interest must be paid for an eligible student who was yourself, your spouse, or any individual who was your dependent at the time the debt was incurred. The taxpayer claiming the deduction must have the primary obligation to repay the loan and actually must pay interest on the loan during the year. An eligible student must take at least 1/2 of the normal full-time load in a degree, certificate, or other qualified program in an eligible educational institution. Interest must have been paid on a loan that was used to pay for tuition fees, room and board, books, supplies, equipment, and transportation while attending the eligible educational institution. An eligible institution includes colleges, vocational schools, or other post-secondary institutions that are eligible to participate in Department of Education student aid programs. The deduction phases out when your modified adjusted gross income is between $120,000 and $150,000 for joint filers. Married filing separate, forget it, you're not allowed the deduction. And for everyone else, the phase out is between $60,000 and $75,000 of a modified adjusted gross income. And for purposes of the student loan interest deduction, modified adjusted gross income includes all amounts excluded from your income under the foreign earned income exclusion or for income excluded for residents of Samoa or Puerto Rico. Restrictions: you are not allowed to claim a deduction for your student loan interest expense if any of the following is true. Number one, you were claimed as a dependent on another person's return, or your filing status is married filing separate, or the loan was made under a qualified employer plan. This can create a problem. Student loan interest will not be deductible when a parent claims a student as a dependent if that dependent has the primary obligation to repay the loan. If the dependent is claimed on the parent's return, then he or she is not able to claim the deduction either. So if a student loan is taken out by the student, not the parents, and the student is a dependent of the parents, and the parents claim that student as a dependent, and the student makes interest payments, no one is allowed to deduct the interest. So if the parents co-sign on the loan and take responsibility for the loan, have a primary obligation for the loan, then they're allowed to claim the deduction for the loan, even though the loan was taken out for the children and not themselves. Tuition and fees deduction claimed on line 34. You can claim a tuition and fees deduction of up to $4,000 for the cost of tuition and related expenses at an eligible institution. These expenses can be paid for you, your spouse, or your dependent. This is another deduction that was set to expire at the end of 2011, but it was extended through 2012 and into 2013 as well. We'll see what happens at the end of this year. Obama and the Republicans don't look like they're going to make any headway on anything this year, so I think 2013 might be the end of it. But then again, 2014 is a whole new year, isn't it? Qualified higher education expenses. To qualify for this deduction, all of the following must be true. The amounts must have been paid only towards tuition and related fees that are paid directly to the institution as a condition of enrollment. Unlike the American Opportunity Credit that allows for the cost of books and supplies, the tuition and fees deduction does not. So we have an example here of where books are not deductible. Jane enrolls at a course at her local community college and pays the following expenses: tuition of $150, a program fee of $20, books purchased at the college bookstore of $60, and $15 for a parking permit. So it costs her $245 to take this course at the school. But only $170 will be deductible as a tuition fees deduction because only $150 plus $220 is actually a condition of enrollment. The books can be purchased from the bookstore or online or anywhere else. They're not a condition of enrollment, therefore they're not deductible, and the parking permit is neither of those things either. We have a second example where the books could be deducted. Sally enrolls in a basic tax course offered through a licensed vocational school. She must pay the following expenses directly to the school as a condition of enrollment. Tuition is $320, the enrollment fee is $29, and books and supplies included in the enrollment fee cost $220. In other words, she can't enroll in the course and not buy the books. They're mandatory. And because of that, she's allowed to treat the entire $569 as deductible. Number two, next rule in line. The tuition must have been paid for you, your spouse, or a person whom you are claiming as a dependent on your tax return. Tuition expenses are deductible if they're paid by you, your spouse, your parent, or another person on your behalf, or through proceeds from a student loan or financial aid programs, so long as the amount is borrowed and must be repaid at some future point and is not a scholarship, for example, that would not have to be repaid. Tuition expenses are not deductible if they were paid by your employer or if they were paid through scholarship or fellowship grant, or you are not required to repay the money being used, except of course in the form of a gift. A grandparent could pay an expense for a grandchild, and then that expense would be claimed on the parent's return, even though the parent didn't pay the expense. The payment must be for tuition and fees that were paid during 2012 for an education period that begins in 2012 or within the first 3 months of 2013. And finally, the tuition must have been paid to an eligible institution. The IRS says an eligible educational institution is any college, university, vocational school, or other post-secondary educational institution that is eligible to participate in student aid program that is administered by the U.S. Department of Education. Also, certain educational institutions outside of the United States who are able to participate in the U.S. Department of Education federal student aid programs can qualify. Non-qualified education expenses, you cannot claim a deduction for any of the following: insurance, medical expenses, including student health fees, room and board, transportation, personal living or family expenses, expenses paid by your employer or reimbursed to you by your employer, expenses paid by tax-free educational assistance from sources such as scholarships, Pell Grants, and Veterans Educational Assistance. You may not claim the deduction for expenses that were not in excess of interest from U.S. savings bonds used to pay for higher education that is excluded from income, tax-free distributions from a Coverdell ESA, tax-free distributions from a qualified state tuition program, nor for books, supplies, or equipment unless the cost of these items is paid directly to the institution as a condition of enrollment. Also, you cannot claim an educational expense deduction if your filing status is married filing separate, or another person claims you as a dependent on their return, or you file Form 1040-NR, or if your modified adjusted gross income is greater than $80,000 or $160,000 in the case of a joint return, or if you are claiming the American Opportunity or Lifetime Learning credits for expenses of the same student that you are using to claim the tuition and fees deduction. And here's an illustration of what we mean by point number 5. A deduction or a credit is allowed. Robin Loxley has 2 sons, John and Will. Qualified tuition paid for John totaled $4,000 and Will's tuition was $5,000. Robin could claim an educational expense deduction for either of these children. However, if he claims a $4,000 deduction for John, he cannot also claim an education credit for John. But he could claim a deduction for John and an education credit for Will. That's permissible. Education credits are covered in detail in our 1040 CPE series course called Federal Tax Credits for Individuals, where we talk in more detail on those. For today, we're just looking at the tuition and fees deduction, and here's how you figure your allowable deduction. You look at the maximum deduction, which is $4,000, and then you look at your income. If your income is between $0 and $65,000, you're allowed the full $4,000 deduction. If you're married filing joint, then if the income is between $0 and $130,000, you're allowed that full $4,000 deduction. If the income hits $65,001 or $130,001 on a joint return, then the deduction drops to $2,000. And if the AGI goes over $80,000 or over $160,000 for joint filers, no deduction is allowed at all. Note that the AGI phase-out works in steps rather than just being a phase-out that graduates gradually. It jumps. Thus, a person who has $65,000 of income is allowed a $4,000 deduction, but a person with $65,001 would only be allowed a $2,000 deduction. How do you claim the deduction? Well, you figure the deduction on the worksheet included with the Form 8917. It's built into there. You basically figure if you're limited at all based on your income and either check yes, you're limited, or no, you're not. And if you're not, you're allowed to enter $4,000, assuming you had $4,000 of expense. And here we have Sally, student. She enters her Social Security number, her name, the amount of her qualified expenses. She enters her income. She's not affected by a phase-out, so she's allowed the full $4,000 deduction. All right. Could you believe that we got to the bottom line of the Form 1040, but we're still not done with talking about adjustments, that there's others? These are called write-in adjustments, adjustments that are still deductible on the return but don't get a line. And if you have such a deduction, you just handwrite in a description of the deduction you're claiming on line 36, right on the dotted line. And some of the deductions that apply under those rules are the MSA Archer MSA deduction. Although there is an adjustment line for health savings account contributions, there is no similar line for MSA or Archer MSA deductions. So if you have that kind of deduction to claim, then you fill out the appropriate form, which is 8853. You figure the deduction, and right here on line 36, you would actually enter the deduction directly on the line, and you would type MSA on the line, and then carry the deduction over to line 36. The next write-in deduction is called jury pay. Have any of us ever sat on jury duty and gotten our $10 a day? Well, that $10 that you received in jury pay is taxable, and you need to report it on your tax return. You would enter jury pay on the line up here, line 21, and then carry it over. And in our illustration, we have $200 of jury pay. That must have been a long trial. You received $200 of jury pay, and it's taxable and entered on line 21. Now, if you happen to work for an employer who paid you while you were on jury duty, and then you decided, well, since my employer paid me, the condition of that payment is that I give to my employer any jury pay I received, and you do that, then you're allowed to claim a deduction for the jury pay that you received on line 36. But the only way you'd be allowed to claim a deduction for jury pay on line 36 is if you included the jury pay in income, but you also paid that jury pay to your employer, and the reason you gave it to your employer is that the employer continued to pay you while you were on jury duty. The next one in line is PPR, which is personal property rental. If you received income from the rental of personal property and you were not in the business of renting such property, enter the amount of income you received on Form 1040, line 21 as other income. I always come to horses when I'm thinking of examples because that's what I have. I have a horse trailer, and for a long time I didn't have a horse trailer. And, you know, I had a friend, she had a horse trailer, right? So maybe on more than one or two occasions I thought to myself, maybe if I offered her $50, she'd let me borrow her horse trailer, or she would rent her horse trailer to me. Well, a horse trailer would be an example of personal property. Now, my friend who rents me her horse trailer for $50, does that mean she's in the business of renting personal property? No, clearly she would not be. But as far as IRS is concerned, if she rents me her horse trailer and I give her money for that horse trailer, that's taxable income to her, and she has to report it on the tax return. Now, in this situation here, we've got personal property rental income that's pretty significant, $4,000. And let's just suppose after renting that horse trailer for $50 a day, maybe I took it out for 2 weeks, so it added up to a little bit more, and I paid her $700, or I took it out long enough that I paid her $4,000, so it fits with our illustration. We get to a point where something happens in the course of renting that personal property, and there's some damage done to the trailer, and so there's an expense related to repairing it. The expense related to the reporting of that personal property rental income is deductible, but you don't do it on Schedule C, you don't do it on Schedule E, you don't do it on Schedule A even. Instead, you enter PPR directly on line 36. Enter the amount of expense related to the reported personal property rental income and claim a deduction for it that way. Other items that are line-in items are RFST for reforestation. If you incurred reforestation amortization and expenses, you may be able to deduct this amount on line 36. See publication 535 for more details. Subpay TRA. If you repaid supplemental unemployment benefits under the Trade Act of 1974, you may deduct the repayment on line 36. All other forms of unemployment repayments don't go there. UDC, legal expenses from an unlawful discrimination claim. This is one I've actually run across. If you paid attorney fees for actions settled or decided after October 22, 2004 involving certain unlawful discrimination claims, you can deduct these expenses on line 36 to the extent of gross income received from the action. You may be able to deduct attorney fees and court costs paid to recover a judgment or settlement for a claim of unlawful discrimination under various provisions of the federal, state, and local law listed in the Internal Revenue Code. The following rules apply to that, though. The attorney fees and court costs may be paid by you or on your behalf in connection with the claim for unlawful discrimination, the claim against the United States government, or a claim under Section 1862 of the Social Security Act. The deduction you're claiming cannot be more than the amount of the judgment or settlement that you receive and included in your income for the year, and the judgment or settlement to which your attorney fees and court costs apply must occur after October 22, 2004. So lots of people get involved in lawsuits, and when they do, they hire attorneys. And if it's a personal lawsuit between you and someone else, or maybe between you and your employer, you're suing your employer because you think that they wrongfully fired you, those expenses, if you're able to recover them, are going to be deductible on Schedule A as a miscellaneous itemized deduction. But if you sue your employer under an unlawful discrimination claim or someone else under an unlawful discrimination claim, then you're allowed to claim your attorney fees as an above-the-line deduction rather than on Schedule A, and of course the above-the-line deduction is better. And finally, code WFB, you use that code if you paid attorney fees or court costs in connection with an award from the IRS for information leading to the detection of tax law violations you may be eligible for on this deduction. So if you, as a tax practitioner, you run across something where you think there's been a violation and you want to be a whistleblower, but then IRS doesn't give you the money you think you're due, so you hire an attorney. You can claim an above-the-line deduction for that. All right, that is it. We are finished with today's presentation of adjustments to income. In the manual, you can see there's a series of classwork assignments.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
So let's then take a look at classwork assignment number 1. We already looked at question number 1 earlier today, so let's move on to question number 2. Frank Ford is a married man, age 51, and his wife Betty is age 52. She is covered by a pension plan at work, but Frank is not. Now let's look at the income. Frank earned $46,000 and Betty earned $51,000. You take those two numbers together and you get $97,000. So what will Frank's allowable IRA deduction be? Well, his deduction is going to be equal to his maximum contribution, or his maximum allowable contribution that he actually can make and does make. And based on his age of age 51, he's eligible to contribute $6,000 to his IRA, and if he contributes $6,000, he will be able to deduct $6,000 because $97,000 is well below the phase-out range for a married person who is not covered by a pension plan but has a spouse that does. And in that case, for Frank, his phase-out range is $173,000 to $183,000, and $97,000 is far less than that. But let's take a look at Betty. What is her allowable IRA deduction? Well, her deduction is going to be subject to a phase-out because $97,000 is more than $92,000. If you are filing a joint return and you are covered by a pension plan at work, then your phase-out range is $92,000 to $112,000. Betty's income at 97 means that her income is $5,000 more than the minimum point at which the phase-out begins. And the phase-out range is $92,000 to $112,000. That's a $20,000 range. $5,000 is 25% of $20,000. That tells you that Betty is 25% of the way into the phase-out range, which means that her maximum IRA deduction is 75% of her allowable maximum contribution. So what does that mean? Well, it means that she can contribute $6,000, but if she contributes $6,000, her deduction will be limited to 75% of $6,000 or $4,500. Now, if Betty contributes only $4,500, she does not need to complete Form 8606 because she is allowed to deduct $4,500. But if she contributes more than $4,500, then she does need to complete Form 8606. And if she contributes the full $6,000, then she would enter $1,500 on Form 8606 as a non-deductible contribution that adds to her basis in her IRA, and she would enter $4,500 as a deductible contribution to her IRA on the front page of Form 1040. The next problem we're looking at, number 4. Jerry is single and age 50. His AGI is $25,000, all of it from his share of income in his partnership. Jerry's Schedule SE reported $25,000 of self-employment income. What is his maximum IRA contribution and his maximum deduction? Well, based on his age of 50, we know he can contribute $6,000. He has at least $6,000 of compensation from earnings, and therefore he is allowed to contribute $6,000 and he is allowed to deduct $6,000. Moving on to the next question, number 5. We covered that earlier today. All of her income comes from alimony. Alimony is considered to be compensation. She is age 45. Her contribution is limited to $5,000. Her deduction is also limited to $5,000. The next question we have, number 6, we looked at Jack, but we didn't look at Mary. Jack is age 49 and his wife Mary is age 51. The Sanders are married, and Jack works full-time at XYZ Inc., and he earned $150,000. He is eligible to participate in his employer's 401k plan, but didn't bother to do it. He decided he didn't want to. The Sanders modified adjusted gross income for the year is $158,000. Mary did not work. What is Jack's maximum IRA deduction? And as we already discussed, and the fact that he decided not to be bothered participating in his employer's plan, or perhaps even didn't think he could, is irrelevant. The fact is that he was covered by a plan, and that means he earned too much. so none of his contribution is deductible. But let's take a look then at Mary. What is her age? She's age 51. That means her maximum contribution is $6,000. How much can she deduct? Well, she can deduct all $6,000 because if you look at the modified AGI of $158,000, that is less than the phase-out for a married filing joint filer who is not covered by a pension plan at work but has a spouse who does. So looking at the answer key for question number 6, we can see that Jack is able to contribute $5,000 because he is under age 50, but he is allowed to deduct none of it. Mary, on the other hand, because she's age 50 or older, can contribute $6,000, but because the modified adjusted gross income of their joint return is under $173,000, she is allowed to claim a deduction for all $6,000 that she contributed. And moving on to Classwork assignment number 2. Classwork assignment number 2 is similar but different than Classwork assignment number 1. In Classwork assignment number 2, we are looking at whether or not the filer can make a contribution to a Roth account. Remember, for traditional IRAs, you can make a contribution to a traditional IRA account if you have a compensation, and to the extent that you have compensation up until you reach the limit for your age. So if you have $6,000 of compensation and you are age 50, you can contribute $6,000 to your traditional IRA, and it doesn't really matter if your compensation is more than 6. All that matters is that it is 6. But when we look at Roth accounts, we're also worried about the top end of your income. If your income goes above a certain level, then you are not allowed to make a direct contribution to a Roth account. Rollovers into a Roth are still allowed regardless of your income, but the direct contribution is limited by your income. So before we begin on Classwork assignment number 2, let's just revisit the phase-out ranges for Roth accounts. Income limits apply to Roth IRAs, and your allowable contribution phases out when your income is between $110,000 and $125,000 if you are single, head of household, or married filing separately but did not live with your spouse at any time during the year. And it's between $173,000 and $183,000 if you are married filing joint or a qualifying widower. And it's between $0 and $10,000 for married filing separately but you did live with your spouse during the year. So then returning to Classwork assignment number 2, at the end of our manual, let's take a look at these Roth questions while we remember in the back of our minds what the rules are relating to the phase-outs. 110 to 125 for single, 173 to 183 for married filing joint, and 0 to 10,000 for married filing separate if you lived with your spouse. And here is our first problem. Todd, age 50 acres, is married to Martha, age 49. Martha earned $45,000 working at ABC Company, and Todd earned $120,000 working for Intel. They also received $20,000 of taxable interest and $1,500 of non-taxable interest. They made no other IRA contributions. How much are they going to be allowed to contribute to the Roth? They're not going to be able to deduct anything, correct? Because it is a Roth. It's a question of how much can they put in there. So let's take a look at the answer. Well, the answer is no. Their modified adjusted gross income is higher than $183,000. In fact, I get $186,500 when you throw in that non-taxable interest. So therefore, they're not entitled to make a contribution directly to a Roth. They could contribute to a traditional IRA and then roll into a Roth, but they can't contribute directly to a Roth. Question number 2. If Todd and Martha filed married filing separate, what would their allowable Roth contribution be? Well, the answer is still 0, because with married filing separate, the phase-out range is between $0 and $10,000, and clearly each of them has income far exceeding that, so there's no point in going separate. That won't affect anything. Question number 3. Jake Edwards, age 35, is married filing separate. He did not live with his spouse during the year. He earned $85,000, and he contributed $1,000 to his traditional IRA. What is his maximum Roth contribution? Well, with married filing separate but did not live with the spouse at any time during the year, you look to the single phase-out range, and that is $110,000 to $125,000. So let's take a look at how much Jake Edwards earned. He earned $85,000. He contributed $1,000 to his traditional IRA. He's age 45. What will his maximum Roth contribution be? Well, his overall maximum contribution between the traditional account and the Roth account cannot exceed 5. Since he's already put 1 into the traditional IRA, he is left with putting 4 into the Roth account. So the correct answer to number 3 is he can contribute $4,000. Then finally, number 4, Tasma is age 35 and Harry, age 30, are married. Their modified adjusted gross income is $175,000 on their joint return. What is their maximum Roth contribution? Well, for this problem, they're in the phase-out range. The phase-out range is 173 to 183. They are 20% of the way into that phase-out range. Based on their age, you can see that they're each allowed to contribute $5,000. So the maximum contribution is 10, and they will be allowed 80% of that maximum contribution. So the correct answer is the maximum Roth contribution would be $4,000 each, or a combined total of $8,000. Classwork assignment number 3 involved preparation of return for George Kelly, and I will pull up the answer key since I'm going to go over the classwork assignment for George Kelly and Darla Kelly in its entirety. Because, of course, with George and Darla, we had a tax return that needed to be prepared, and that tax return includes preparation of the following forms: a 1040, a 3903, an 8606, an 8917, and the IRA deduction worksheet. We already took a look at the moving expenses together, but we also have a situation where the Kellys contributed $5,000 to their IRAs, and we want to figure out how much of a deduction they're allowed to claim for those. So we have to look at their income for the year, and we have to look at the value they had in their accounts for purposes of completing the 8606. And we have a situation here where there's also a student loan interest amount that was paid by George. There is an education expense for George. He has a 1099-8T in here of $800. And we have a W-2 for George showing $102,000. Well, what is the phase-out range for a married person who is covered by a pension plan at work? It was between $92,000 and $112,000, wasn't it? And so he's into that range. It looks like he's about 50% into the range. And Darla is homemaker, so she's not covered by a pension plan at all. You can see right away that based on their income, she's going to be allowed a full IRA deduction, but he's going to be limited and needs to do an 8606. So I'm going to pull up the answer key. And earlier today, I did show you the answer key for the moving form, 3903, but now we're going to take a look at the rest of the return. So up on page 1, we show that W-2 of $102,000. There was also some interest income that we've entered, and then we get on to figuring that his income before adjustments is $102,700. There were some educator expenses described in the wording of the problem. We deduct those, $250. There was the moving expense amount that I showed you earlier in class. $541 of that is deductible. And then we have the IRA deduction amount. We know we're allowed a full deduction for Darla's contribution. George is allowed only a partial deduction, and you can see ultimately the deduction that we computed for them was $7,530. And then we have the student loan interest deduction of $2,500, and we have a tuition and fees deduction of $800. All of those have been entered on the lines. But let's go figure the IRA deduction, because that's the most complicated thing in here. And to do that, we have the IRA deduction worksheet. And we can see that George has a pension plan, but Darla does not. We enter the phase-out limit for George. We enter the phase-out limit for Darla. We then figure the modified adjusted gross income for George. And remember, we had to add back certain adjustments into income, and we also had to include other forms of income besides his W-2, which is why we end up with a number that isn't exactly the same as his wage. We end up with $101,909 for the modified adjusted gross income. We do a math calculation, and we get a number way, way higher than $10,000 for Darla, and that means she's allowed her full deduction. But for George, we end up with a number of $10,091, and the way the formula works is we're going to take that number, carry it over to page 2, follow the entries, and you end up with ultimately $2,530, so slightly more than half his contribution is deductible to him. And for his wife, Darla, all of it's deductible. We get $2,530. And then here are the moving expense amounts that we calculated for them. There is also an 8917. George has to file this form in order to claim his tuition and fees deduction of $800, but they're well within the phase-out range. He's allowed that deduction. And then there's an 8606 form for George. His non-deductible contributions are reported on this form. We have his basis from earlier years. We have the non-deductible part of this year's contribution, and then we have his basis going forward to future years. And again, with more time on your hands, you can slow down, perhaps even work through this computation by hand. At the end of the manual, there's also a homework assignment. That homework assignment is not required for webcast students. It's only required for our self-paced, self-study students. And if you want to take the homework assignment, you're more than welcome to. For self-study students, it's mandatory and you have to for course credit. Answer keys for these assignments can be found inside of Open Canvas, the learning management system. Whether you're a webinar student or whether you're a self-study student, they are there for you. So that concludes our presentation of adjustments to income. We thank you very much for joining us today. I certainly hope that you enjoyed the presentation and learned a great deal. Thank you again, and I hope you enjoyed the class. We hope to see you again soon. Bye-bye. Password number 3 is now showing on the screen in front of you. Please write it down. Password number 3 is Paladin, P-A-L-A-D-I-N. Password number 3 is Paladin. Please write it down.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.